trader. I am a successful trader. I learn from my mistakes. I am always improving myself. As I improve myself,
thoughts exactly. Which way are we going to pivot?
backdrop, our performance underscores the importance of having a scaled, diversified, and global franchise that can support clients across a wide range of market conditions.
We didn't mention their Q1 credit provision, Jim. Pretty mild at $300 million.
Look, I continue to believe that this is a good quarter. And it's just very difficult when you raise the estimates so high that he can possibly beat them. And yet, if we had thought these numbers were going to come out this way 3 months ago, we would be paying 950 for it. That's why I say, listen, you can't. This is not the kind of quarter that you can grade Goldman on, because they could, turn it down 40. I mean, give me a break. The fact is that this was. He can't say it. He can't say, listen, we beat the old numbers, because no one cares about that. But in the end, it was a great quarter. It's second best after 2021. That's great, but it's not enough for now. Once they start buying back, it'll be enough.
Yeah, a long week ahead of financial results, that's for sure. As we go to break, watch bonds. Not a lot of data today. We'll get existing homes in a few moments, and then Myron speaks around 6 p.m. Eastern time tonight. As Jim mentioned earlier, that 10-year really loves 4.3. Stay with us. Interesting few days for restaurants. We got an upgrade to Shake Shack last week. Today, Jeffrey's up Starbucks from sell to hold. They go to 92. They say China's gotten franchised. U.S. is stabilizing. Some better visibility on their turnaround. Jim, although they say still there's a premium in there.
Yeah, I think that when the Chinese deal closed, people were excited. I think it's going higher. But at the same time, I recognize that what it did last time. They reported, whichever so I said, I'm going to speak about it on Thursday's call as being, you know what, look, it's nice, but it's not ready.
Yes. We will get Stop Trading with Jim in just a moment. Time for Jim and Stop Trading.
We're focused on these data center winners. And Nebius, NBIS, I saw them last year at the GTC conference that NVIDIA has, and I kind of I felt badly. I went over there and said, how you guys doing? No one was around them. And then this year, well, since then, they've won a Microsoft contract. They got a $27 billion Meta contract. So people just are crazy about it. And you can see what happens when you have the ability to be able to put up more compute. And now Nebius is a company that's losing money, kind of like CoreWeave. But like CoreWeave, they might just say, you know what? What's the point of making a profit? If you remember, Michael Intrater said to me, well, we can be profitable 3 quarters if you want us to. This company is just a rocket ship, and I just want to point out that it deserves it. It keeps getting contracts. But if someone's worried and thinks that, well, all these things are going up without profits, there you go. I wouldn't short or sell this one up. I wouldn't.
CoreWeave too, almost back to those January highs.
Well, I mean, these are companies that help. If you're short compute and Anthropic is, then you just, the easiest way to get more is to just give them money and have them build. It's an amazing time. It's amazing. It's kind of a magic time for anyone who's involved in data.
Jim, what are you going to do tonight?
I got a company, Supergroup, which got out of U.S. gambling and went overseas. I don't know if you noticed, but the U.S. gambling market, ever since Polymarket and Kalshi was really in disarray, they pulled out, and they met with tremendous success. So gambling in the United States has become very problematic.
Well, yeah.
A lot of people
take a look
bet,
at DraftKings stock price. That'll show you the story of what
I know
Polymarket and Kalshi have
a lot of people bet on
business.
Masters and Polymarket, not on DraftKings. Pretty amazing.
Jim, we'll see you tonight. Long week ahead.
Wow.
At
Oh, yeah, but we're ready.
6 p.m. Eastern Time. When we come back, a U.S. naval blockade of the Strait of Hormuz set to take effect in the next few moments. Former Defense Secretary Esper will join us to break down the strategy when we're back in 3.
Is this your dream of retirement? How about this sweet deal? I like fishing. Or is this a little more your style? Retiring well isn't a guarantee, it's a goal. It's easy when markets are going up. But what about when they're not? That's why you need this.
Call for Fisher's Retirement Survival Kit, featuring your guide to surviving market volatility, our stock market outlook, plus the Fisher Investments Difference. 3 indispensable guides, yours free for calling 1-800-213-5317.
Fisher Investments' disciplined approach will help see you through the market's ups and downs and give you the confidence you need to reach a comfortable retirement. And our fees are structured so we do better when our clients do better.
Call now for your free retirement survival kit. 1-800-213-5317.
See if your dream retirement is on track.
If your portfolio is $1 million or more, call Fisher today. Call 1-800-213-5317.
A heart attack? Do they have life insurance?
No,
But we have life insurance. John.
I'm trying to find something we can afford.
Fortunately, in only a few minutes, SelectQuote found John a $500,000 policy for only $29 a month, and his wife Ann a $500,000 policy for only $21 a month. Go to SelectQuote.com now and get the insurance your family needs
at a price you can afford. SelectQuote. We shop, you save.
It's always great to be around people that do the same thing you do every single day as a CEO, but have it in a completely different place.
To be able to meet people who can have conversations with about challenges instead of me going out and trying to find 20 people in my network, it's a time savings.
That free discourse, saying what you actually believe, that's what breeds solutions, ideas, and change.
Explore CNBC Council's memberships at cnbccouncils.com/success.
Good Monday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live, as always, from Post 9 of the New York Stock Exchange. President Trump's blockade of the Strait of Hormuz slated to take effect right now. We will talk about that development in this weekend's Pakistan negotiations with former Defense Secretary Mark Esper. Plus, the chairman of Sunoco with us to discuss the war's ongoing impact on gas prices and the impact on consumers, and much more on Goldman Sachs' post-earnings move as the conference call continues this hour with the stock down almost 4%.
First, so let's get some breaking housing data. It's just crossing, and Rick Santelli has it for us. Rick?
Yes, indeed, and this is existing home sales for the month of March. And do remember, March is post-conflict, so interest rates, especially those affecting mortgages, come in on the light side. 3.98 million. 3.98 million seasonally adjusted annualized units. That is definitely sequentially lower than 4.13 million in the rearview mirror, and definitely less than a 4.05 expected. That equals where we were in June of last year, right on the nose. To find a lower rate, you would have to go back to all the way back to September of 24, Sep of 24. So this is a disappointment, but there might be some silver lining here. With interest rates moving up a bit, impacting negatively existing home sales, we do expect inventories to rise a bit, and that could help out in the future when potentially rates normalize and the conflict ends. Carl?
set to begin blockading Iran's ports beginning this hour after ceasefire talks failed to yield a breakthrough over the weekend. Our Megan Casella has the latest from Washington. Morning, Megan.
Good morning, Carl. That's right. That naval blockade set to take effect at 10 a.m. Eastern, and U.S. Central Command has said it will apply to all maritime traffic entering and exiting Iranian ports. CENTCOM saying in a Sunday statement that the blockade will be enforced impartially against vessels of all nations entering or departing Iranian ports and coastal areas, including all Iranian ports on the Arabian Gulf and the Gulf of Oman. President Trump then added on Truth Social that the U.S. Navy will also intercept any ships that pay a toll to Iran. And then, guys, we got a few more details this morning from a note the U.S. military sent to seafarers, which was seen by Reuters, including that any vessel entering or exiting the blockaded area will be subject to interception, diversion, and capture. But the note said the U.S. will not be impeding neutral traffic to or from non-Iranian destinations. That said, the Iranians will be blocking that traffic. An Iranian military spokesperson reportedly saying in response to the U.S. actions that if Iranian ports are threatened, no port in the Persian Gulf and Sea of Oman will be safe. President Trump, guys, described it this way. He said there will be a time when we'll have them all come in and all come out, but it won't be a percentage. It won't be a friend of yours, like a country that's your ally or a country that's your friend. It is all or nothing. That's about the traffic through the Straits of Hormuz and through the Gulf. So essentially, a move here to ramp up the economic pressure on Iran to get them back to the negotiating table, to try to ensure that they're not able to only allow the traffic that benefits them and to cost Iran's economy likely hundreds of millions of dollars a day in lost exports. So now, guys, the question will be what it looks like in practice and what it means for the global economy as well.
And what it means, Megan, for the duration of this conflict, you know, now that we're sort of out of the window of how long we originally expected it to last.
Absolutely. That's what's been notable, that for all of the action over the weekend, we didn't get really any sort of update on the timeline for the ceasefire, which as of now is set to expire next Tuesday, April 21st, so just over a week from today. We have seen reports from the Wall Street Journal that the president is considering more limited military strikes, potentially upending that ceasefire early. Axios says that mediators are looking to schedule another round of talks before the end of that ceasefire, but no confirmation from the White House on any of that. So at this point, we don't know if or when this brings the Iranians back to the table, how long the U.S. is willing to keep it up, and really what they want their next step to be.
Okay, Megan, thank you very much. Megan Casella with the latest on Iran from the White House. Obviously, here on Wall Street, we watch the energy price, the oil prices, and another spike today, 5%. We're off the highs on WTI, but still looking at really substantial gains. And then the question on the economy becomes, can consumers handle it? How will consumers hold up in the face of rising oil and gas prices, which have already spiked pretty high? I thought one chart was particularly encouraging this morning. It comes from Bank of America, and it shows that in March, we saw really strong spending. This is total credit and debit card spending per household, rising 4.3% from last year, and that's the strongest growth since early 2023. This is according to Bank of America's internal data. They look at all the credit card point of sale data and everything like that. And, higher gas prices are a factor here because we're obviously spending a lot more at the gas pump, so that gets factored in. It surged 16.5% month over month. But if you look at the total card spending and exclude gas, you still saw pretty healthy spending growth, 3.6%. So one thing, David, I would take away from this is watch what they do, not what they say on the consumer. We saw really weak confidence reading at the end of last week. Obviously, the gas price weighs on sentiment, but overall, spending is pretty good. Maybe it's the tax refunds. It's certainly split among high income, low income. With low income spends a much greater share of their purchasing on gas. But overall, it's resilient, even in March, in the face of these higher gas prices.
Is that surprising to you?
I think it's a little surprising, right? Because, even if our economy and consumer spending is less dependent on GDP than, say, it was in other oil price spikes, which it is, you psychologically, you'd expect there to be a bit of an impact. You watch that tick every time.
Right, even though it is a smaller as a percentage of overall budgets than it certainly was during other price shocks that we've had many years ago, for example. I do wonder at what point are we going to start to see products coming from places like Asia, given the input costs there are going up dramatically. That hasn't happened yet, but could it happen?
Yeah, sure. I mean, look, the economies that are most dependent, obviously, on oil are on oil
through the Strait, that goes through the Strait of Hormuz.
Hormuz are mostly in Asia, and those economies are feeling it the worst. The Korea, Japan, and Myanmar and Malaysia and all these countries. But, so far, as far as the U.S. resilience and the U.S. consumer, it hasn't manifested deeper in terms of underlying inflation besides the overall headline price. We got that CPI report last week, and yes, we saw a big spike in the headline number, which was expected. I think it actually came in a little better than expected. But it's the core that matters, which is taking out food and gas prices, which are volatile, and so far it's okay. There's another great chart from Pantheon Macro, which looks at their forecast for core CPI. That's the orange. And they see it continuing to come down. I mean, where we are is kind of like where that box is right now. Obviously, headline is going to stay firm. I'd say there's the spike on oil prices. But core, they see a deceleration on core prices. And they're looking at all sorts of things like unit input costs, which actually have pulled off a little bit. Wages have pulled off a little bit as well. And there's a spike in, obviously, gas prices and airline fares and that sort of thing, which are tied to it. But they say, actually, for the remainder of the year, it should move down and that the Fed will continue to cut rates.
We'll see. Curve is not as friendly today than it was last week, and Goldman today actually raises their headline PCE by a full point for December. They go to 3.1. They raise their core for December to 2.5. They cut their GDP for the full year.
It's the core that the Fed's going to have to pay attention to and try to process whether the core is moving up enough for them to have to keep holding or potentially hiking. I would say after the CPI report on Friday, it was good news that core came in as expected at least.
Yeah, second biggest jump to energy CPI ever.
Energy we expected. Energy we knew. But traditionally the Fed is supposed to look through these energy price shocks because they are temporary.
Let's hope.
Let's hope.
Major averages are mixed this morning after last week's rally. Joining us this morning to talk about the market action is Kate Moore, Chief Investment Officer at Citi Wealth. Kate, good to have you.
Yeah, great to be here.
You sort of agree with this resilient consumer theme.
I definitely agree with the resilient consumer theme. In fact, we've seen the consumer in pretty good health, really, for the last number of quarters. Remember, it's been now like 8 quarters where everyone has been calling for the death of the consumer. And I'll be honest, I've been also talking about the K-shape, but instead, we've actually seen even the lower-end consumer, because the labor market's been pretty solid, hold up even better than many people expected. I think one thing I was reflecting on, actually, Sarah, as you were talking, was, expectations for Fed rate cuts and inflation. And I will say some folks are trying to get back to the policy is going to ease, and that'll be really good, especially for interest rate sensitive consumers. We've been in the camp since last fall, frankly, that the Fed should not be cutting rates because of the stability in the labor market, and frankly, because the breadth of actually core inflation that was running higher than 4% or 5% annual clip. I think we're going to see that broadening out even further as some of these energy shocks feed through into prices over the next number of months. And so without that boost, I'm going to be watching very closely whether or not the consumer can hold up well with higher gas prices and actually, more and more surcharges coming through and hitting their wallets.
I mean, the story Friday was about real incomes.
Yeah.
Negative real personal disposable income. And a saving rate that's come down to 4.
Yeah. I think this is going to be very interesting because people want to be constructive in spending going into the summer months, in travel, et cetera. But these are all areas where we're expecting to see significant increases in prices. And the uncertainty factor has increased, even for those people who are geared to asset markets, benefit from the rise in stock prices, et cetera. I'll be watching their behavior very closely because this is also potentially an inflection point.
Are you surprised the stock market's up today?
I am surprised the stock market's up today because, last night when I was doing work prepping for the week, of course, futures were down in a pretty significant way. And while we are expecting earnings to look very good, particularly for kind of those secular themes around technology and AI infrastructure in some parts of industrials, I wasn't expecting that optimism around the earnings to really come out until, later in this reporting season.
Do you think that's what this is about? Better earnings trajectory, offsetting some of the risks of these higher oil?
Yeah, the market's only focusing on one thing at the moment. They're exhausted by the news flow and the headlines around the conflict in the Middle East and the energy implications for many different companies and economies. And I think they're trying to look forward and say, what can we pull from the first early reporters and say,
it's really a glass. It's a glass half full kind of approach that the market's taken, given the magnitude of the rally last week on hopes of a peace deal that didn't come to fruition.
Totally. And positioning sentiment technicals are a big crisis with Iran. Positioning and sentiment were pretty tepid. I mean, the market was not fully invested in some of the higher quality U.S. large caps. They had rotated away. We knew that story very well. And so I think because there was even a drawdown there, everyone has been looking for a reason to step in. Everyone's been looking for a positioning thing to kind of get back up to neutral. So we'll see.
The other topic of note over the weekend was the separation between software and Mag 7.
Totally.
And whether or not some of these bullish ROI stories coming out of Mag 7 are going to widen that spread.
Yeah, look, it's really tough because there are outstanding software companies that have a place, we think, in portfolios, even if AI disrupts lots of business models. But everything is being thrown out or kind of cast with the same light. And I just don't know that sentiment's going to change to get people interested in investing in some of these stronger software companies. So even if we see solid fundamentals, I expect we'll see more derating across the space in the near term.
Yeah, we'll keep our eye. It seems like we put up the IGV like every few minutes.
Yeah.
Kate, thanks so much. Good to see you.
Yeah, thanks for having me.
So here's our roadmap for you for the rest of the hour. Still ahead, former Defense Secretary Mark Esper on why he's in favor of this blockade in the Strait of Hormuz, why he says it should have happened sooner.
Plus, Sunoco Chairman Ray Washburn is going to be with us as consumers do deal with those surging prices at the pump.
And why Goldman shares are sinking this morning despite a solid beat on earnings and revenue. Squawk on the Street is back in just a moment. sales, and they've been flat. They've been down about 1% or so. But what's interesting in the restaurant business, so much of our business has shifted from in-house dining, which together used to be around 5-6%. Industry right now, it's over 20% because of DoorDash and Uber Eats and things like that. So that's been an interesting translation since the pandemic on that happening. But we're looking at, we just haven't seen the consumer, and I don't know if that's a hangover, frankly, from the pandemic, where people are like, I'm still going to go out, I'm still going to enjoy life, and they're
Right.
still
Well, I mean, you've got pretty interesting exposure at Highland Park. Obviously, you've had high end as well.
Absolutely,
So
yeah.
across the board, are you seeing? Is there anywhere you're seeing weakness or something you're concerned about?
And the high-end shopper and our, because we're the kind of the peak, we haven't seen any correlation or I mean correction there at all. I mean, sales are very, very strong in the United States. I'm not speaking to luxury in China or other places. In the United States, I think things have been fine. The casual dining sector, again, is down about 1% or so, but nothing alarming at all. We've had no issue with labor. If anything, we have too much labor in the United States right now.
Really? Because I remember a time when obviously labor was a concern for you.
People are coming out of college and not getting jobs. We've had no issue in that. Our commodity prices are fine, except for beef. It's the only thing we had an issue with. Other than that, it's a pretty stable economy for us right now in the restaurant business.
I was going to ask about inflation, because we were also having a debate, so strong consumer, but we were having a debate about whether the higher oil and gas prices would feed into underlying inflation. Or are you seeing it pop up anywhere else?
Well, oil and utility cost, electric cost, I mean, that for everyone is skyrocketed. And so, but our restaurants, things like natural gas, the United States has so much natural gas. You know, most restaurants have, gas stoves and things like that. And natural gas prices haven't gone anywhere. They've pretty much stayed flat through all this.
So, that's pretty benign.
Pretty benign. Now, you look in Europe, okay, because we do have European operations.
Yes.
The problem in Europe is 80% of diesel in Europe goes through the Strait. 80%. The United States, all ours now is domestically produced. So Europe, Asia right now, like Vietnam, they've canceled domestic flights. Jet fuel in Asia is starting to have a ripple effect back through Europe. Diesel trucks, that's how commerce is delivered, is through trucks, through diesel. And so Europe is going to be the next shoe to drop if this extends too much. The great thing in the United States, we are energy independent.
Yes.
Totally energy independent from the rest of the world. Totally different from when I got my driver's license in 1976, you had lines down the street. We have an incredibly efficient distribution network in the United States, from the refineries to the midstream, to the terminals, to the stations. And we don't have those lines in the United States, and we won't.
Rig count fell on Friday, and I wonder, do you think it's a matter of time before these producers add some rigs?
You know, I think everyone looks at it and just thinks this is a real blip. And yes, rig counts are dropped, but also in the Permian Basin, look how much consolidation there has been. So the oil companies are looking at it going, we need to maintain. We start throwing a bunch of rigs out there and oil drops back to $60 a barrel. We've hung ourselves out. So why do it?
We should mention you are here, of course, to make sure you steal every single job available in New York and move it to Texas.
That's right.
Something we're not really interested in celebrating, right? But I am curious as to whether your view is colored by the fact that the Texas economy has been quite strong.
Yeah, well, the reason I'm here today, we rang the bell for the city of Dallas and the mayor of Dallas, talking about Y'all Street, not Wall Street, but Y'all Street in Dallas. Goldman Sachs is building a new downtown Dallas campus, and they already have 2,000 jobs in Dallas. They're bringing 2,500 more, so they'll have 4,500 people there. JP Morgan now has more employees in Texas than in New York. Scotiabank just moved 1,000 jobs to Dallas. So New York Stock Exchange just opened a branch in Dallas, as well as NASDAQ. The Texas Stock Exchange has started. So we really, through regulatory at the state level and down in our city level, are really encouraging moving these financial jobs from. We're not so much looking to steal from New York. We also want to take from Chicago and other cities.
Great.
Too.
Yeah, you just leave us a lot of restaurants and museums.
Right. Great place to do it.
But my question was about the Texas economy and whether, are you seeing full, do you feel like you get a full national picture on all the things you're talking about quite positively?
Well, yeah, look, Sunoco, our stations is a national
but Highland Park's called, obviously,
Yeah, but it's local, but I have a large center, Country Club Plaza in Kansas City, and we have centers in other parts of the country. We have a large piece of downtown Aspen, which has done extremely well, but I don't know if they ever know a recession in Aspen. But
will there ever be a recession in Aspen?
I don't think there'll ever be a recession in Aspen, but we're hearing that, and in the restaurant business, I'm very involved in the business nationally, and we're kind of hearing the same thing in the casual dining. But there's still a lot of bankruptcies rippling through private equity going into these restaurant businesses, and
right. Well, Red Lobster, obviously, you got a couple of those, right?
Oh yeah. So, but what I'm encouraged
right now in the pause in the economy, are people feeling pain? They are, but as you said earlier, I mean, the percentage going to the gas tank is so much smaller than ever it was in the past, and people still want to go out and enjoy life. And so we're encouraging that.
Well, Ray, we always appreciate your stopping by. Thank you. Ray,
thank you for having me.
Really good color. Still to come, former Defense Secretary Mark Esper with us on the blockade of the Strait of Hormuz and why he says he's not surprised peace talks broke down. But first, the new numbers from Goldman Sachs as a blockbuster week of earnings gets underway. We'll be right back. Welcome back. Goldman Sachs beating earnings and revenue estimates this morning thanks to a surge in investment banking fees and equity trading. But the company did post big declines in trading around bonds, interest rates, mortgages, credit. The fixed income group missed estimates by nearly $1 billion, while asset and wealth management fell a little short as well. At the top of the earnings call last hour, CEO David Solomon highlighted the macro environment, putting a little bit on sentiment and saying volatility increase. He cited AI disruption, private credit uncertainty, the conflict in the Middle East. But executives overall did say that the underlying economy remains relatively robust. Maybe talking about that volatility there in the markets, particularly related to bonds. It's been a strong performer, David and Carl, which, perhaps is why it's given back about 3.5%. And then look at the one-year performance overall.
No, it was a very strong quarter. With that return on equity, almost 20%, that certainly caught a lot of people's attention. They bought back, $5 billion worth of stock during the quarter at higher prices, we should point out. So perhaps a lot of that did take place. Well, you can see that period there in January where it was higher than it is now. But it was quite a strong quarter. Perhaps just they had numbers out there that were just not quite as obtainable. Yes.
Perfection.
Yes. Thank you.
Yeah. I mean, overall, like the financial sector, even despite some of the wobbles around private credit and some of the concerns there on some of the alternative managers,
Yeah, and I mean, Solomon did say some things about private credit as well, didn't he? And just we raised $26 billion across asset classes with private credit strategies, generating $10 billion. We recognize private credit has been an area of increased focus, he said on the call, but talked about their rigorous underwriting, as you of course expect he would, and talked about the drawdown structures institutionally and the breadth of their origination funnel, giving them flexibility. So not unexpected, but defending their strategy on private.
By the way, a lot of those names are higher today. You know, after a string of losses. The overall resilient market. S&P's flat right now, but you know the KKRs and the Blackstones and the Apollo catching a little bit of a bit.
Yeah,
we talk about them on down days. So
I know. No, you should mention that. It's not often you see Blue Owl up ever.
And by the way, financials are still the second biggest decliner on the year so far. It's been a race between consumer discretionary and banks all year long.
Yeah, because of those credit concerns.
All right, let's get a CNBC News update. Seema Modi has that for us. Seema.
Good morning, David. A federal judge this morning dismissed President Trump's defamation lawsuit against the Wall Street Journal. The president sued over an article saying the president's name was on a 2003 birthday greeting to late sex offender Jeffrey Epstein. The judge said the president did not reach the actual malice standard that public figures must clear in defamation cases, but could be refiled the suit. The Federal Trade Commission is reportedly negotiating with several big advertising companies to settle claims they illegally boycotted online platforms, including Elon Musk's X. That's according to the Wall Street Journal. A report says under a potential settlement, ad companies would commit not to steer clients' ad budgets away from sites based on political content that could appear on those sites. And the Super Mario Galaxy movie still on the top spot at the box office, the sequel earning $69 million at the U.S. theaters, bringing its domestic total to about $308 million. Including international ticket sales, the Mario Galaxy movie has now grossed $629 million. Guys, back to you.
All right, KP, thanks. After the break, former Defense Secretary Esper is going to join us as this blockade of Iran's ports reportedly gets underway. And check out a big biotech mover today. Revolution Medicine surging on news that its pancreatic cancer drug did succeed in that phase 3 trial that was on the tape Friday. Stay with us.
Welcome back. The blockade of Iran's ports officially underway as of this hour. President Trump vowing to take action after peace talks between the U.S. and Iran stalled over the weekend. Joining us now is former Defense Secretary Mark Esper, who served during President Trump's first term. Secretary, it's great to have you back with us. Why? I think you're in favor of this move. Why?
Yeah, look, I think it's a smart move, Sarah. We need to put pressure on the Iranians to come to the negotiation table, willing to concede some things, and the military pressure has not nudged them, pushed in that direction. So I think the economic pressure of cutting off their ability to draw revenue from sales to Asia and other parts of the world is another way to put pressure on them. So I think it's a smart move. We should have done it actually when the Iranians first cut the Strait off.
So do you think that it will work, that they will capitulate?
I don't know, but I think it will take time, which is why this conflict is likely to be drawn out at least a few more weeks. But we'll see. You know, they derive a good chunk, a majority at least, of their income from oil sales, and that is the means by which they can rebuild their country. They can purchase arms. We learned this weekend that China may be shipping them shoulder-fired air defense systems. So it's the means by which they buy the means of war to defend themselves and to keep the regime alive. So we'll see. I think either way it will take time to determine if it will compel them to be a little bit more yielding at the table.
Do you expect a response from China, for instance, which has been, I think, pretty quiet throughout this entire conflict because they're so dependent on some of this oil that goes through the strait?
Yeah, that's the interesting part. I mean, there's been some rhetoric out there from the early days where they condemned the conflict, etc. But what interests me now is the fact that, first of all, there's this report about China shipping arms to the Iranians designed to shoot down our aircraft. And then, of course, the announcement today about the United States blocking Iranian shipments, again, most of which would go, or a big chunk of which would go to China. And then we've got to keep in mind that the Beijing, the summit between President Trump and President Xi is just in a matter of weeks. And does he want to go into that summit, not just with this conflict in the background, but also the cutoff of oil to China also being an issue at the table when they sit down?
How do you think about China in a larger context, Mark? I'm just curious, particularly in light of the fact when you talk to investors about one of their biggest fears, it has to do with Taiwan. A typical question is, what's the market going to be down on the day that China makes a move on Taiwan? I'm just curious as to how you think about what you just discussed in the larger context.
Look, it's our biggest strategic adversary in this century. It's one of only two countries that pose an existential threat to us. They've said that they want to modernize their military by 2035 and push us out of at least the Western Pacific by 2049. And I don't think we're focused enough on them. Well, the other thing is what's not being reported right now is while we've been focused the last, 7 weeks now on the war, China is building up more islands in the South China Sea, islands designed to control the South China Sea. So we're talking now about a country exercising control over trade and commerce in the Strait of Hormuz. And meanwhile, China is building and preparing the means to exercise that same type of control in the South China Sea. And that's where, frankly, 80% of commercial trade passes through that part of the world. So we need to be more focused on China, frankly.
Yeah, we haven't, for a while there, we had a couple days of headlines about the THAAD systems and our missile defense assets being moved to the middle. You think we let our guard down in Asia?
I just don't think we're paying enough attention on it. I had to do the same thing during my tenure as defense secretary, to move assets around to manage the risk at the time. And right now, obviously, we're at war with Iran. But again, we need to build up the forces. We shouldn't have to move assets around as much as build more assets, but then stay laser focused on what China is doing in that part of the world. We now know that Iran has a stranglehold around everybody in the West with regard to oil. But keep in mind, of course, China has it with regard to rare earths and with regard to certain other strategic materials and solar panels and all types of other things which they've been building for decades. The ability to not just own those markets and dominate them, but to use them in economic conflict against us.
Yeah, Friday's headline was about China looking at a ban of sulfuric acid, which is sometimes called the king of chemicals because of the things you need it for in manufacturing.
Right. Yeah, no, it's a problem. That's why I said what we needed is a full court press against China. I think in the first Trump administration, we were focused like that, to have a diplomatic strategy, an economic strategy, a military strategy, working with our friends and allies, of course, Taiwan, but Japan, and Australia and the Philippines. And those countries, along with Korea, have come a long way, especially Japan, in terms of taking a more aggressive stance with regard to China and building up its own defense capabilities that we really need to leverage. But right now, we're focused on Iran for good reason, obviously. But we need to have a broader, strategic, persistent focus on China across all domains of conflict with them.
So just to finish where we started on this blockade, which has apparently begun this hour, what does it mean for, the potential of opening the strait at some point, which is what ultimately needs to happen to get energy prices down, things moving again, and weaken Iran's leverage on being able to block that?
Well, I'll just say a few things. First of all, it doesn't really cut off the strait because the Iranians had cut off the strait. What it does is deny Iran and Iran's friends the ability to trade. So I think that pressure, again, will take time to build. They only export a couple million barrels of oil per day or so to getting out of the strait. It'll have some impact on global prices, number one. Number two, we really need to globalize this conflict. We need our allies in both Asia and Europe to step up, participate, help out, begin with diplomacy, apply economic sanctions if they haven't already, but also provide platforms, whether ships or planes, to help enforce freedom of navigation in the strait. And then the other thing we have to do, Sarah, I think, is keep our eye on the clock. This will take some time if we just stick with economic pressure on the Iranians. But one thing folks maybe have forgotten, that the next threshold for the War Powers Act comes up at the end of this month. And Congress is going to have to vote on whether they're going to sustain this war or direct the president to bring forces home. And that's going to be 2 weeks away. I don't know if the Iranians are watching that clock, but it's going to say a lot about a support for the war here in this country. And that'll obviously have a political impact.
Yeah, we'll be watching that. That tension is there. Thank you, Mark Esper, for now. We'll talk to you soon. Former Defense Secretary.
Next up right here, the executive chairman and co-founder of one biotech company whose stock is plunging on an FDA denial of a key treatment for melanoma. We'll be right back. Replimune, take a look. They are down 67% today. This after the FDA denied approval of its melanoma treatment. It's a major setback for the company and a closely watched moment as well for the broader immunotherapy space, not to mention the FDA and its approval of new drugs. Joining us in a CNBC exclusive is Replimune's executive chairman and co-founder, Philip Astley-Spark. Of course, I guess we'll start off. Nice to have you here, by the way. Tough day for you guys. What do you do now, other than sort of speaking publicly about, I guess, what you felt was an approval process that was, unfair?
Yes. Shall I start by explaining why we think it was unfair?
Sure. Why don't I start with a question of why was this approval process? By the way, we should point out, you guys, I mean, we've dealt with this previously. It was some 6 months or more ago when seemingly the review panel said yes, then got a no, then you got another review, and it's a no again. So they said no twice. Why do you have an issue with it?
Okay, so we developed a drug for late-stage melanoma for patients that have failed standard of care and have few other options. They're at high risk of death. The standard of care is a drug called anti-PD-1, and these patients have definitively failed it by having confirmed progression across 2 scans while on the drug. Our drug, RP1, resensitizes patients to anti-PD-1, and we put a third of these patients with few other options into durable response, either reducing their disease burden for years or completely eliminating their disease burden. So very powerful data. So the FDA had 2 issues with the data. The first issue is the way we assessed tumor response, which was exactly the way that we agreed with the FDA and they asked for, and they signed off on the chart. They had issues in the way we assessed response across a number of metrics. One issue was the fact that patients that were doing well on drug, after 1 course, you carry on giving the drug. They took issue that they say, retreated patients.
Why would that matter?
It would not matter. From a patient standpoint, how could that matter? You're benefiting as a patient, you want more of that drug. You don't say, well, I just want 1 course for some kind of methodological purity.
You had a 34% remission rate in half the patients, isn't that roughly correct?
Yes.
And that was potentially years of survival.
Well, we can't prove it's survival. It's highly likely to translate into survival. You would then prove that in a much larger, very expensive confirmatory study that we're running.
You had a lot of support amongst the oncologist community, I believe, as well, correct?
So the oncology community were outraged in the first rejection, and they wanted to make sure this didn't happen again. And 4 weeks ago, a who's who of melanoma KOLs wrote to the FDA making sure that this drug should be approved. Ditto, a who's who of KOLs around the world and in Europe wrote to the FDA saying we need access to this drug, as did all the patient advocacy groups. So I want to continue in terms of this tumor assessment piece too. So another issue that the FDA said was that we took biopsies in these patients, and that by itself could reduce tumor burden. We provided them with the hard data that's not the case. I mean, how could it be the case? Otherwise
we'd all be just doing biopsies as a potential approach to helping.
We were doing acupuncture to cure cancer. And then the other kind of like very pure methodological pushback they said on the tumor assessment methodology was that our drug's like a vaccine. You inject it into 1 tumor and it makes the uninjected tumors also go away. In some cases, the entire tumor burden is injected. In most cases, it's not. Okay, so you can prove that the vaccine effect is happening. And the response rate in uninjected tumors is exactly the same in those patients as the injected tumor one. Now, what they want to do is if a doctor basically decided to inject all of your lesions, they want to discount that as actually being meaningful. However, if you inject all your lesions and you basically bleed through your standard of care therapy in 3 months and then they don't come back for many years, do you care as a patient whether or not the doctor injected all your lesions?
No, I don't.
Or left one uninjected?
Philip, we have little time here, so I want to try and get to the heart of the matter here. What does the FDA have against you then? Do you believe you've been unfairly treated, was my original question.
We've been very unfairly treated.
But why? Do you have a reason as to why that might be the case?
I'm really puzzled, and I think it needs to be got underneath. But moreover, we're now in an existential crisis as a company. So this drug is likely, it's not like it won't reach patients for years, it's like it will never reach patients. And I think that given the unfairness, I call upon the Commissioner to have an AdCom with melanoma experts, a large panel of melanoma experts where we present all the data that we have to basically show that those confounding issues that they raised are not confounding issues, and get that into
what
actually
do you
a
think
transparent
this goes back
public
to? Is it just a
dashboard.
resistance on the part of the FDA, perhaps, to approve therapies that they feel are not going to be necessarily in the best interests of the broader healthcare economy?
I have to say I'm completely confounded, and the FDA should explain why they have put methodological purity ahead of patients' lives.
Can you survive as a company?
I think we're in an existential crisis, and that remains to be.
You had a sales force, right, that you actually had and were still paying, and the assumption that you were going to get
the
approval.
The assumption was, in good faith, when they said that we were allowed to resubmit again, and they accept that resubmission, that we would get approved. So we kept our sales force, and it's unconscionable. They then asked us no questions in the second 6-month review period. They did one information request where we actually addressed all of those issues, and then they wrote those issues as if we'd never even bothered putting in the reply. So it's infuriating. I think there should be an investigation, and I also think that there should be an AdCom so that we can get this drug to patients who urgently need it.
Well, at some point, perhaps we'll try and have the FDA commissioner join us here as well to understand at least their side, but certainly appreciate your taking time. Thank you.
Thank you.
All right, still ahead on the show, how the oil move could impact the market over the next 30 days, according to the options market. We're going to head to the SIBO next. And a quick programming note, we're just 2 days away from CNBC's Invest in America Forum. It's happening Wednesday in Washington, D.C. You can still sign up. Leaders from various industries, high-profile big public companies, Treasury Secretary Scott Bessent, CEOs of FedEx, U.S. Steel, ARM, Hyundai, Apollo. Visit CNBCevents.com to learn more.
Welcome back. Oil once again above $100. Got to 104 earlier today as this U.S. blockade of the Strait of Hormuz begins following failed peace talks with Iran over the weekend. Let's bring in Jason Coogan, floor trader at Simplex Trading, live from SIBO Global Markets in Chicago. Jason, good to see you. Thanks for the help today.
Hi, thanks for having me on.
Kind of odd to see both the S&P and WTI in the green. What do you think's happening with the relationship between oil and stocks?
Yeah, it's been a wild ride the past few months. We had oil, which was an asset class that was really underperforming the market overall. You know, trading near $50 a barrel before the conflict began. And then all of a sudden, once this started, what I saw was a direct correlation between the move in oil and the inverse move in the financial markets. It really was like a tail wagging the dog kind of event. So it is odd to me to see oil up and SPOOs up right now, but you know, we see a lot of fluid things happening with the negotiations, and people are kind of on the edge to see where this is going to go.
Yeah, since the war began, oil's up, 62, 63%, and stocks are essentially flat. How do traders process that?
Yeah, the oil move really, the biggest effect I saw was its effect on VIX and volatility of the options market in general. It really changed the mindset of where options should be trading. But prior to this event, we saw VIX solidly in the mid-teens. Was very happy there, traded there in a very tight range. And then with this geopolitical event occurring, that entire risk metric has been reset to a much higher level. Now it trades in the low 20s, and really that probably seems very appropriate for what is going on in the world and in the markets itself. We don't know on a daily basis if... Go ahead.
I was going to say, looking back at the VIX, I think it was that March 9th high around 35. Do you think we get back to that?
With the power of social media and the president's, whether it's desire or just want to, post tweets at any time he sees fit, we definitely could see, anything is possible. Anything's on the board. I do think if we saw a major spike like that, more than likely it would be short-lived. And when we have seen these spikes in the S&P, we have seen a lot of market order flow with people willing to sell that increase in volatility and benefit from collecting higher premiums.
Finally, I wonder, there's been sort of this discussion of, I think they're calling it sort of hedging exhaustion. Is that a dynamic you think is a real thing?
I do. I think with how the market just takes, simple, incomplete facts that come out, and it might be with the increase in programmable trading. No one really knows how to totally interpret one tweet versus the other. Right. So like what we saw on Tuesday, where there was a ceasefire and everyone thought, this situation has ended. We saw the market respond with a 2.5% rally, and we saw the VIX go from 25 to 20. But then over the course of that day, we saw volatility as the market digested that go right back almost to exactly where it had started the day prior. People are basically unsure of what's real and what's not.
Jason, thanks. Good stuff. Jason Coogan over at Simplex and SIBO.
Thanks for having me.
When we come back, Goldman executives taking Q&A this hour. In a moment.
and welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, shares of Goldman Sachs under pressure despite reporting its best ever quarter for banking and markets. With JP Morgan, Wells, Citi, and others on deck, we're going to dig into expectations for the financials with KBW CEO Tommy Show.
The president's blockade of the Strait of Hormuz now in effect. We're joined by one top Mideast advisor for the Obama White House who says recent evidence suggests it won't work.
And OpenAI taking a swipe at Microsoft in a new memo seen by CNBC. We'll explain coming up.
As for markets, trying to look at the glass half full for now as oil comes off the highs. We got to 104, currently right around 102.70. Dow's down a touch on Goldman, but NASDAQ is trying to get a 9-day streak, which would be the first since December of 2023. Let's begin with the surge in oil prices as the U.S. begins its blockade of the Strait of Hormuz. Pippa Stevens has more on that. Morning, Pippa.
Good morning, Carl. The market is viewing this as an escalation and would impact Iran's exports, which have continued to flow freely at about 1.5 million barrels per day. Over the weekend, an Iranian tanker bringing 2 million barrels of crude to India for the first time in 7 years. That's according to Tanker Tracker. Now, OPEC releasing its monthly report this morning showing a record 7.88 million barrels per day drop in production last month, led by Iraq, Saudi Arabia, the UAE, and Kuwait. Aramco's east-west pipeline that ends in Yanbu and the UAE's pipeline that runs to Fujairah have been key for making up for some of those lost barrels, but they do not cover everything. It's important to remember that while the U.S. is the world's largest energy producer and a net exporter, we still rely on imports for key markets and products, including oil itself. We export about 4 million barrels per day of sweet domestic shale and import about 6.2 million barrels per day of heavy sour crude. The majority of that comes from Canada and Mexico, but about 8% is from the Middle East. And on the product side, the East and West Coast are most exposed, with gasoline coming from countries including South Korea, which has implemented export restrictions. Now, oil is well below the highest levels overnight, which saw WTI hit 105.63. Brent front month is now trading just shy of 101, I should say. And on Friday, dated Brent, which is for immediate delivery, priced at $100 and $126. That is according to S&P Global Energy. And guys, again, speaks to that disconnect between the physical and the paper markets.
Okay, Pippa, thank you. We'll turn to the equity markets now, see how all of this impacts stocks. Our next guest is upgrading U.S. large-cap stocks to overweight from neutral. That's as large-cap ETFs largely underperform the S&P 500 year-to-date. Here with us now at Post 9, Neuberger Berman Private Wealth Managing Director Holly Newman-Croft. Welcome back. It's good to have you.
Great to be here. Thank you.
I mean, yes, last week there was such a big rally on hopes of a deal, and this week we come in, there's no deal, and stocks are pretty resilient, trying to sort of climb this wall of worry and also not paying as much attention to the rise in oil prices. What does that tell you?
Well, look, we're 6 weeks into this conflict with Iran, and the market moves on headline volatility. It was down earlier today, now essentially flat. But what we've seen this year, going back to the beginning of the year, is volatility with concern around tariffs. Volatility with concern around AI and its potential elimination of the software space. Now we're 6 weeks into this conflict. And the good news on the volatility, perhaps like the market, I'm a glass half full person, is that we've seen a real compression in multiples in the U.S. large cap space. So the real overhang there has been valuations, and we have seen that come down. The forward PE multiple of the Mag 7 has gone from 30 to 24. So we are seeing real attractive entry points in the U.S. large cap space. That doesn't take away our emphasis on the importance of a diversified portfolio, but perhaps to take some of the gains that our investors have benefited from in developed international and reallocate those in better values in the U.S. Large cap space is one of our new views.
It's not like international hasn't also gone on sale, or EM.
International hasn't gone on sale, nor has EM, but international has such a run. We favor EM over developed international, so perhaps lock in some of those gains. Don't exit it. Just lock in some of the gains and take advantage of the opportunities. The real critical difference in the U.S. large cap space and what we saw each of the last 3 years is that it was basically 7 versus 493, right? It was the Mag 7 and they moved as a group. Today, investors are rewarding individual companies for strong business plans, dependable free cash flows, predictable free cash flows. So it is really an environment for stock selection, active active management and not expecting one group to move in tandem with its peers.
It's been a while since you have liked the sort of mega cap tech stocks, hasn't it?
Listen, the S&P is up 80%. We started the year with the U.S. up cumulatively 80% each of the last 3 years. So valuations have been a real concern. Can you invest and still make money? There have been more attractive opportunities in international, in EMD, safer asset classes. But this volatility today, we think presents an opportunity for investors to take advantage of some of the compression in the multiples.
Do you worry at all about the over-investment concerns around AI? I mean, that's really the fear, right, with some of the hyperscalers.
You could have ended that question after, do you worry? Yes, of course, I worry. But listen, AI and the concern around software, again, that's going to be selective. It's right now the whole software industry, the whole private credit industry has been punished. But there will be winners and there will be losers. And specifically in private markets, and we've talked about this before, private markets are not as efficient an asset class as public markets. So firm and manager selection in the private credit space is critical. The concern, as everyone knows, is that AI is going to eliminate the need for some of these software companies that these private credit firms have exposure to, and then they'll default. That will not happen universally. So investing with high-value, high-quality managers with proven track records, low default rates is going to be even more critical. We've always emphasized it, and it will prove to be true again this time.
The other thing that's interesting to some is old economy, transports all-time high, new economy, stocks all-time high. Do you take profits in either of those, you think?
I think you can take some profits. I think there's no harm in taking some profits. I think what we need to worry about, going back to the question about do I worry, the real concern today, and the market isn't reflecting it because I don't think if they're so concerned, is the duration of the conflict. So if we get out of this conflict in a relatively short period of time, oil will come down, the price at the pump will come down. If oil hits $150, $160, $170 a barrel, and the increase at the price at the pump extends to the increased prices of goods that our consumers have to buy, that is inflation. That will lead to higher rates. That will lead to much broader problems. But this is a midterm election year. The focus is on affordability. So I think it is in the administration's best interest, the country's best interest, the consumer's best interest to resolve this conflict in shorter order than otherwise.
I feel like the stock market has Trump's back. You know, everyone walked in today thinking that it would be a tough day, oil prices are high, and you know what? It's pretty resilient.
It's incredibly resilient, and I think resilient is the theme of our consumer, our labor market, our economy, and until something like, if we see prices of goods increase, those will not come down. The price at the pump will. It won't happen overnight. It won't happen right when we have a resolution, but it will come down. But if it creates a higher price of goods, that is permanent, and that is inflationary, and that is going to cause a
Are you guys changing any of your bond allocations or anything around the inflationary outlook?
So we are constructive on investment-grade fixed income. We do see the opportunity for rate cuts the second half of the year. I know the market has priced that out of possibility. But again, if this resolves, we do see, and Kevin Warsh gets established, we do see the possibility for some cuts later in the year. We have not eliminated them.
Okay, yeah, the market's not there yet. Holly, thank you. It's always good to have you.
Thank you so much.
Holly Newman-Croft from Newburgh Bourbon.
Still to come this morning, former Middle East advisor to the President Obama, Puneet Talwar, is going to be with us. We'll talk about the implications of this blockade and whether negotiations can continue.
And later, CEO of KBW with us. That's as bank earnings kick off today with Goldman Sachs. Much more on that quarter and what we can now expect from the rest of the banks. Money Movers. We'll be right back. Welcome back. Shares of Goldman Sachs today heading lower despite a beat on the top and bottom lines. Leslie Picker joins us now with some of the highlights from the earnings call. Leslie.
Hey, Sarah. Yeah, that downside surprise stemming from the firm's FICC business, comprising fixed income, currencies, and commodities trading and financing. That business missed estimates by nearly $1 billion due to lower revenue from trading rates, mortgages, and credit. FICC financing, which also includes providing leverage to private credit funds, was actually higher in the quarter. Provisions set aside for losses were also up on a combination of higher activity and impairments in specific credits. Wells Fargo's Mike Mayo notes that this increase in provisions within global banking and markets was the highest since 2020.
I do think we all have to recognize that this has been a very long credit cycle, and when credit cycles go on longer, market participants, this is a generalization, this is not the way we think about the business, but spreads get tighter, market participants get more aggressive to deploy capital, and so when you do have a cycle turn in a recession, you will see higher losses across the space than you would have had if it was a shorter cycle. And so we have to be cognizant of that.
Solomon said that private credit continues to be a, quote, attractive platform, but not a huge growth channel for them in the medium to longer term. He expects to be, there will be continued noise around the retail space, something they haven't been as susceptible to because their funds are more institutional in focus. Solomon noted that sponsor or private equity infrastructure real estate activity has been a bit slower than they'd expect, but the firm still posted a record in its global banking and markets division. That was largely thanks to equities trading and prime financing and the closing of markers Goldman had helped manage that led to an 89% jump in advisory revenue in the quarter, guys.
Okay, Leslie, thank you very much. Leslie Picker with the Goldman commentary. Busy start to earnings week for banks tomorrow. We're going to get JP Morgan, Wells Fargo, Citigroup, followed by BofA and Morgan Stanley Wednesday. Joining us here post 9 is Tommy Show, the CEO of KBW, a Stifel company. Welcome, Tom. Unusual to kick it off here with Goldman Sachs. Not really setting the same tone like a JP Morgan for overall banks, but definitely for markets and investment banking. And it's pretty strong, isn't it?
Yes, and again, Goldman gets more than half of their revenue from trading type, markets type activity. So it's very hard to take Goldman and put it all over the entire banking industry as a benchmark. But look, they still earned 21 on tangible common equity in the quarter. They still, I think, by all intents and purposes, had a good quarter. I think it's notable that the risk-weighted assets grew 12% in the quarter, so they had a lot of growth in the quarter. But, you know, this stock has tripled over the last 2 years. Not surprising to see it not continue to be robust, and that this is profit-taking. They probably had to beat estimates even more to get this stock to keep moving because it's already at a pretty high valuation, and it's moved a lot.
Yeah, you don't read anything into the miss in fixed income?
I don't, and you know, and it, very easily you could have other firms that have a very strong quarter. It's rare for an investment bank to have every one of their business lines outperform in one given quarter. But you know, as we move over to the core banks, we're looking for them to have 16% earnings per share growth for the quarter. You know, we entered the quarter with a lot of really good green lights. We had earnings per share growth. We had positive operating leverage. We've got loan growth. We were expecting excellent asset quality in this quarter for banks. We are, even in private credit. And there's also going to be, I think, a surprise like there was for Goldman, lots of share repurchase, and we have historic regulatory reform going on at the same time. So I think the underlying belly of the core banks is very good.
On the discussion about the credit cycle, you don't think provisions will be a story by the end of the week?
So I think provisions are going to go up, and not to get too wonkish right here, but
we love wonk.
We love wonk. All right, I'll go wonk. Okay, you have a loan loss provisioning model. Okay. And like, let's say if economic forecasts come down, that means uncertainty goes up. So you need to provide more for the uncertainty. So I thought was interesting in the Goldman quarter is, yes, they provided more than they had previously, but they didn't have more losses. It's just an ounce of prevention and caution. And also when you have good loan growth, you have to provide for those loans. That was an accounting rule change of many years ago. So the banking industry is going to have good loan growth, and they're going to have provisions to keep up with it. And the models are going to tell them, because of the economic outlook, to be more cautious. It's more important to watch delinquencies, past due loans, and net charge-offs. And that's where in our channel checks, even in private credit, we're expecting the first quarter to be a good quarter.
Yeah, what are you expecting to hear in terms of exposure from these big banks on private credit?
So the private credit story, I think has multiple layers to it. I think the growth story is the first one. If you look back over the past decade, the average annual growth rate in commercial loans for banks, 3%. The growth rate for private credit, 12. The growth rate for BDCs, 21. And the banks haven't grown much in the last decade, mainly because they had a lot of regulatory constraints, which are changing, which I think is part of the bull story. But the other thing is, we saw, I think from a lifetime perspective, an incredible amount of inflows by wealthy people into private credit funds. And now we're seeing the other side of that on the redemption side. And those funds are essentially illiquid long-term funds with a little bit of liquidity. It looks like those investors now with like a little more liquidity. So I think that the future for the next 5 years for private credit is going to be one about how fast is it going to grow and what is the market share with banks going to look like. And I think that's a very interesting angle. As far as credit goes, in the history of my career, you usually look for who grew the fastest for where you may see problems first. This whole credit story, just like David Solomon just said, the whole industry's been over-earning on credit. The surprise has been how good credit quality's been. It's going to normalize, and just like we were talking about earlier, the banking industry is going to get out in front of it. They're going to put reserves out before it happens so they can deal with it. So I think as an analyst, you think, is it a crisis or is it manageable? I think certainly in the banks, it'll be highly manageable, and I think some private credit funds will do a great job, and like most sectors, some may not.
Do you think this this meeting with the Treasury Secretary on Anthropic and Mythos was material? I don't know if it came up in the calls today. We'll find out.
Yeah, I don't know. I probably not, because I think that the industry. I touched base with a very sophisticated institution recently, and I was talking to them about how they were thinking on AI. They said, Tom, will you call next week because it'll be different. That's how fast it's moving. And what's interesting is I'm seeing it, but I'll tell you, I'm seeing it being used more and more and more. I have more and more colleagues coming to me. I have more and more clients, more and more investors. The rate of usage and change is accelerating and exponential and constantly shifting. That's why I say that, because whatever that meeting was last week, I think most of these banks are keeping their fingers in a variety of different ways to make sure they don't miss the one that really works. That's my observation. I have to tell you, I love thinking about 5 and 10 year plans. You need to be more efficient, and not just banks, everywhere. If you're not going to be more efficient, some fintech or some technology company will find a way to go after your profit margins. And you better be on the AI train, because the world's going to be those who's using it and those who aren't. And that's going to be applicable to every industry segment. So I think if you want to be a long-term player, you need to be focusing on AI and how your team is using it. It doesn't mean I think it's going to necessarily disrupt you entirely, but I think it could very much change what your profit margins look like.
Market a little frozen here with the Dow being dragged down by Goldman, but the activity is kind of in the Nas today, going for 9 straight gains. Software definitely trying to make a stand. Salesforce and Microsoft are the best Dow names at the moment. Oracle up 7+ will get your attention too, leading the S&P today.
A little bit firmer treasury yields on the back of those high oil prices, but nothing extreme. And maybe that's keeping the stock market calm too. Time now for a news update. Seema Modi has it for us.
Sarah, we're looking at new comments from the Pope Leo, telling journalists today he has, quote, no fear of the Trump administration after the president lashed out at the pontiff on Sunday, calling him weak on crime and terrible on foreign policy. Pope Leo responding by saying the message of the gospel is clear when it says, blessed be the peacemakers, and that he will continue to proclaim it. In other news, Roblox said today it will introduce new age-based accounts for young people beginning in June. Roblox says it will tailor content, communication, and parental controls to be more closely aligned with user ages. Roblox earlier this year rolled out an age verification system to limit communication between adults and users under the age of 16. The move comes after several lawsuits accuse the platform of not doing enough to protect kids. And Meta CEO Mark Zuckerberg is reportedly training an AI clone with his image and voice, along with his mannerisms, tone, and past public statements. According to Financial Times, Meta may start allowing creators to make their own avatars if the Zuckerberg experiment goes well. One to watch. Sarah, back to you.
Okay. Thank you very much, Seema. Still ahead, former Middle East advisor to President Obama, Hanif Talwar, will join us. We'll discuss what a blockade of the Strait of Hormuz means for the course of the war and whether negotiations will continue when we come right back. Welcome back. President Trump threatening 50% tariffs on China after a report suggesting Beijing was planning to deliver arms shipments to Iran. Eunice Yoon joins us from Beijing with more on the reaction there, Eunice.
Yeah, that's right, Sarah. China has denounced the reports, calling them groundless smears, and criticized President Trump's tariff threat, saying that they are unproductive. When asked about President Trump's blockade through the Strait of Hormuz, the foreign ministry urged for unimpeded navigation. Now, China is one of the main countries that would be most affected by a blockade. It not only is a major economic and trading partner for Tehran, but Tehran accounts for 13.4% of China's seaborne crude. So from an economic standpoint, that number might not sound critical, but politically, it could become a point of contention between the U.S. and China at a time when both sides have been really trying not to see a re-escalation of tensions, especially with President Trump coming here in exactly a month. Both sides have been working at that. There is a chance that the leaders decide that the summit is more important and kind of move things along, but it's very unclear how Beijing would react if, for example, a Chinese ship were to be blocked and searched by the U.S. Navy, because for China, this wouldn't be so much about Iran, but about China's losing face and its ability to trade with any country that it wants. So potentially it could be forced, even if it didn't want to, react just because they wouldn't want to be seen as weak in the eyes of the Chinese public. Sarah?
So Eunice, you mentioned the portion of oil that China gets through the strait from Iran. What about, the rest of the Middle East doesn't get a ton of natural gas from Qatar, for instance. Just what is how dire is the oil and gas situation for China at this point? Where's it sourcing from?
Well, it is sourcing from the rest of the Middle East. In fact, the UAE's Crown Prince is here, and they're having discussions. But I think that one thing that China has been able to do is that it has been able to stockpile months' worth of oil. It also has been diversifying away from oil, so it doesn't have to worry as much since they have a lot of, say, for example, EVs and other types of technologies. So China has been able to try to make itself less reliant on outside sources of energy. At the same time, of course, it does not only have oil that's coming from the Middle East, but a lot of other products that are coming here, the inputs and different chemicals that then are shipped out in the form of other types of Chinese goods. So it's a really important region, and one of the reasons why the Chinese want to see a ceasefire and have been calling for kind of smoother relations, because they don't want to be hit as hard, especially at a time when economically, they'd like to be doing better.
Yeah, no, they have very much an interest in this outcome, have having worked with Pakistan and setting the terms of those initial ceasefire talks. Eunice, thank you. Eunice Yoon in Beijing tonight. For more on Iran, we're joined here at Post 9 by Puneet Talwar, former Secretary of State for Political Military Affairs and senior White House Iran advisor under President Obama, ambassador to Morocco under the Biden White House. It's great to have you in. Thanks for joining us.
Great to be with you both.
Thoughts on how this blockade would work and what happens if we wind up with a confrontation with the Iranians or if a Chinese flagship wants to move through?
Yeah, we're in a particularly tenuous moment right now. I think that the U.S. military, the U.S. Navy, I have no doubt, will be able to successfully execute an order to enforce a blockade. The question is, what does Iran do? And I think what we've seen are threats already coming out from them this morning that they're basically saying, if we can't trade, then nobody else in this region is going to trade. And we're going to then target port facilities amongst our Arab allies. And if that happens, you could see a cycle of escalation develop here. And the real question is, where does this lead? Will it actually work? I know that the Trump administration is trying to use this as a point of leverage and to pressure Iran to go down the diplomatic path and make a deal. But so far, what we've seen is that escalation of pressure has not produced results with Iran so far, and I don't think we have any evidence to suggest that it will this time either.
Does Iran have the capability militarily? I mean, didn't part of the goal was to destroy their navy, right? Do they have the capability to inflict more damage to the rest of the ports, as you said, that they're threatening?
They do, unfortunately. We have destroyed, as you said, thousands and thousands of targets. But Iran is basically able to respond through asymmetric means. They have a lot of speedboats. Many of those are still intact. They can carry out actions through unconventional means, and they still have some ballistic missiles and some drones in their stockpile. And they've been using those, and we saw that right up until the ceasefire, maybe even slightly thereafter, that they continued to use that to strike targets, including, for example, the East-West pipeline in Saudi Arabia.
So are you surprised that they still have that sort of capability and they've been able to hang in there?
No, I'm not surprised at all. And I think that we've known for a long time that this is a capability and a conflict that Iran has been preparing for decades. And so this is a very tough problem to crack.
Journal reported on Friday they probably have maybe 1,000 pounds of near weapons grade uranium. You think that's the locus of what will eventually be hopefully a diplomatic solution?
Yes, for us that is not just the material, but preventing Iran from getting a nuclear weapon. We cannot lose sight of that. That is the most critical issue. And Iran with a nuclear weapon would be a disaster on so many levels. So we have to keep our eye focused on that. There are other important matters, but this is really the priority. So we have to go after what we need. So there's a nuclear capability, and there's a new issue which did not exist before the war, and that's the Strait of Hormuz, which allows Iran to have a stranglehold on the world economy. So those two issues are the most important for us. For Iran, the key issues are making sure there's no further attacks on them, making sure that they have sanctions relief, and they want to hold on to some ability to enrich uranium for symbolic purposes and their own pride, even if it's a small, minimal capability. And so we have a wide gap in positions. It's driven by a wide gap in perceptions. Both sides think that they have the upper hand, and I think that that is then translating into this positions gap.
Right. And as far as other voices that might be at play, NATO allies seem to want to try something different. We just heard from Eunice on China. How do you think about those players?
I think they have an important role to play, and particularly in terms of pressuring Iran from the point of view of China, they can play an important role there. Europe, I think, is unhappy with the way all of this has gone down, particularly with us, and it comes on top of tensions that have been building over the last year. So they have a role to play, but they're not central players. The central players in this are the parties in the conflict, the United States, Iran, Israel.
And then do Gulf allies tip the scale one way or the other? We hear conflicting reports about whether the Saudis want this to be decisive and continue versus others like Qatar who might be tired of attacks.
There's a split within the Gulf, but I think from their point of view, they do have a common, I think you would say, a desire for an outcome here. Number one, they want to make sure that the strait is open because their economies are being strangled. There are reports that we're seeing forecasts of countries. So that's number one. Number two is that they want a resolution to this. They do not want to see a repeat. They want stability. They don't want to be left with a vindictive, angry Iran that can do this again.
Is that possible with this current regime?
It is possible if we get the right agreement in place.
Is diplomacy I mean, you know, they always say you can't negotiate with terrorists. Is diplomacy possible here?
It is possible. It's worked before, but I think it's going to take a lot of realism on both sides. It's going to take us getting what we need, not necessarily everything what we want. And to borrow a phrase from President Reagan, we have to have verification. This cannot be built on trust. There's no trust. So to your point, Sarah, we cannot trust them, but we can certainly verify an agreement.
Right. Like you feel that you did during the Obama administration?
Yes.
Do you think we would have ultimately been here if that deal stayed?
No.
Really?
I do not.
They were. I mean, it didn't include their missiles. It didn't include. I mean, they got so much money to fund terrorism. It feels like we would have been here anyway.
I think that we never know the future for certain, but I think that decision to withdraw from the deal put us on the trajectory that got us to where we are now, and I believe that we could have, for example, extended that deal. You could have gone into other dimensions of it, and I think we have a lot of capability, as we've seen, to be able to box Iran in.
Penny, we'll see what the coming days bring. Hopefully, ceasefire holds and talks renew. Market would certainly appreciate that. It's good to see you.
Good to see
Thanks
you.
so much, Penny Thomas.
Thank you.
Coming up, CEO of industrial supply distributor Maximo is with us. That's not getting lower despite earnings and revenue coming in here pretty much in line with expectations. We're going to talk much more about the quarter, the impact of supply chain disruptions, and more next. Plus, just 2 days away from CNBC's Invest in America Forum in Washington, D.C., where the Treasury Secretary Scott Bessent will be kicking things off.
Welcome back. Software is having a decent day today. The IGV ETF is up better than 4%. Some say a little short covering here. Seema Modi has more on that. Morning, Seema.
Hey, Carl. What we're seeing really is that the biggest losers on the year in software are now rallying the most, led by Oracle, up about 9%. We're hearing from one source that Blue Owl went to the bond market with a bond offering. Separately, you have CoreWeave CEO telling Squawk on the Street, your guys' team, on Friday that those GPU depreciation risks are overplayed. If that's the case, that would also be good news for Oracle, given that it's been buying thousands and thousands of chips to house in data centers it's developing. As you see, stock is up about 9%, but still down on the year. Other winners right now, Salesforce, ServiceNow, that got beaten down last week, higher today by around 4 to 6%. And then the data cloud infrastructure names rebounding following a positive note from Morgan Stanley. So names like Datadog, Akamai, and Snowflake. The team there saying that we see a disconnect. This is the team at Morgan Stanley, the disconnect between the reality that managed agent offerings are taking over responsibilities of these data infrastructure names. You'll see those stocks are higher on the day as well, Sarah.
Okay. A big much-needed boost for those guys. Thank you, Seema. Take a look at shares of Fastenal, sharply lower this morning despite reporting earnings and revenue that came in line with expectations in the quarter, pointing to a slight improvement in industrial production with net sales up 12% year on year. Joining us now on the CNBC exclusive is Fastenal CEO Dan Florness. Dan, welcome. It's good to have you. Love diving into this one with you because you make all sorts of, fasteners, safety gear, industrial products. Such a good read on that environment. What does the market look like right now?
From the tone of our end market, it's actually good. Our business since last summer has been slowly ramping up from a growth perspective. We've been double-digit growth. We estimate about 3.5% of our growth, and we're growing low double digits right now. So a piece of it is pricing, but it's really we really highlight in our earnings call and our release the number of customers we're adding and customers that are doing 10,000 a month or more, 50,000 a month or more, and how we're gaining customer business.
What do you think is driving that uptick in manufacturing?
I think it's good, solid demand. We sell into a wide range of markets. About 75% of our business is manufacturers of different types, and that business is growing in the teens. But in addition to that, we sell to a lot of other folks because we're really a supply chain partner for the stuff they need. And one unique angle we take is we are located very close to our customer, and we embed in our customers' locations a lot of technology for them to understand what they're doing. But the underlying business is good, and I think the ISM is a good indicator of that. It's been plus 50 now for 3 consecutive months after being in the 40s for almost 3 years.
Yeah, although also in ISM has been prices paid, and I know costs and trying to keep pace with pricing has been a tough road, and that led to some of the discussion today with your gross margin. Do you think you can take more price and keep up with those costs?
It's a difficult environment. We saw it a really difficult environment here in the first quarter. A lot of uncertainty until the Supreme Court came out with IEEPA. There's a lot of fatigue in the marketplace. We're having discussions with our customers, and we are raising some pricing or changing some source of supply. But the discussions are taking longer than they would have been taking 6 months ago.
You mean in terms of getting deals to close?
Of getting pricing. It might take an extra 30 or 60 days of discussions. At the end of the day, supply chains have become more expensive, and we're relaying to our customer optionality as far as pricing, optionality as far as market source, product source, but it's a slow, as I described on the earnings call, a slug.
Of raw commodities, are you most worried about, steel or aluminum or something else? I'm just trying to think of when you get to the raw end, what's most worrisome at the moment?
Yeah, for us, steel isn't. A big piece of our business, we sell threaded fasteners, which is steel. That piece of our business, our supply chain is long enough that we can really communicate well with the customer. So in that part of our business, that margin is causing us pressure. causing us pressure is some of the safety products, some of the cutting tool products, a lot of products that are very brand specific. The branded manufacturers are very aggressively were raising prices in the latter half of 25 and the first part of 26.
So I'm just looking at the stock, it's down 7.5%. What do you think is going on there? What are you hearing from investors? You've had a good, pretty decent run year to date, outperforming the market overall, but do you think it's the margin story? Investors wanted more profit on the back of growth, or what?
I think the margin story is part of it, and we don't give guidance, so sometimes and we're very blunt with how we answer questions. Sometimes you can see a reaction like that, but I think the market was looking for a little bit better gross profit performance out of us.
And just finally, you sounded very optimistic and sort of bullish about the industrial economy. Where specifically do you see the most demand picking up?
So we're seeing it broadly across all customer bases. We're seeing it broadly across our network, both geographically and market. The one area that has surprised a little bit is our non-res construction business. We participate in a broad market, so I've had 2 recent visits with customers that was very centered on data centers and what they were seeing in their business. But our construction business has picked up.
Dan, is this our last time getting you on air?
Well, I'm stepping out of the role in mid-July, so if you invite me back in July, I'll be happy to hop on. But other than that, I'll be stepping away from Fastenal.
Well, congratulations on a nice 30-year run at the company.
Thank you very much.
We'll get you back before July. Dan, thank you.
All right. Have a great day.
You too.
Still ahead, a new OpenAI memo touting AWS, but actually criticizing Microsoft and Anthropic. We'll get you those details after this quick break. OpenAI executives praising the company's partnership with Amazon in this new internal memo over the weekend, but taking some swipes at Microsoft and Anthropic. Our Kate Rooney's been covering that all morning today on today's Tech Check. Hey, Kate.
Hey, Carl. So this is all according to an internal memo that we viewed. It was sent out by a top OpenAI executive, sent to employees on Sunday. It came from Denise Dresser, the chief revenue officer over there, who talks up OpenAI's new deal with Amazon in a way that, and says it's a way that OpenAI could actually win contracts with companies looking to use ChatGPT for business. At the same time, downplaying Microsoft. So Dresser is a former CEO of Slack as well. She writes in this, our Microsoft partnership has been foundational to our success, but she says it has also limited our ability to meet enterprises where they are. She says for many, that's bedrock. She's referring there to Amazon's AI offering. And since we announced the deal, she says in February, that Amazon deal, she says inbound demand from our customers for this offering has been frankly staggering. The memo does come, guys, a couple months after Amazon agreed to invest up to $50 billion in OpenAI. It does also underline efforts recently we've seen to reduce the reliance on Microsoft from OpenAI. Longtime backer of that company, Microsoft has invested more than $13 billion in this company since 2019. And OpenAI has also been trying at the same time to diversify to more cloud providers. We've seen evidence with Google and Oracle. And then Microsoft, on the other hand, working on its own AI model. No comment from Microsoft on this, but both companies have said that relationship remains strong. And finally, Dresser also slams rival Anthropic and the $30 billion revenue run rate this company put out recently. For context, OpenAI is closer to $25 billion, according at least to its latest update. Dresser does claim that Anthropic's run rate is, quote, inflated by around $8 billion. It argues that it's using accounting treatment that makes revenue look bigger than it is, including grossing up revenue share with Amazon and Google. Says OpenAI reports Microsoft revenue as net. She says that's more in line with standards that would be held. This company would be held to if it were public. Anthropic has pushed back hard on this as it comes down to Anthropic actually being the principal in those deals, and that the accounting here is consistent with GAAP practices. It all depends on the circumstances for each deal. But the back and forth all comes down to this race for enterprise business is a much higher margin, very important battleground in AI, guys. Back to you.
Kate, I'm just thinking about this ongoing dogfight, obviously with Anthropic and the showdown as they both approach the public markets, but also their long-standing feud with Elon Musk. Now this degradation of relations with Microsoft. I mean, it is so competitive, the relationships out of that company.
I think that's one takeaway. OpenAI is battling on two fronts. Obviously, Anthropic with the enterprise side, that is really the business battle. And then they've got this animus with Elon Musk, or at least we have Sam Altman versus Elon Musk. We have a couple weeks from now. The jury selection is kicking off in that trial where all of these top executives, at least on the Musk side, are expected to testify. It is so fiercely competitive, and it's getting quite personal. I mean, these companies are really going back and forth. You're seeing it whether they're criticizing the revenue. It doesn't end. And so it comes down to sort of the business side of it, but OpenAI really fighting two fronts here on Anthropic and also Musk, which has a competitive offering to OpenAI with Exit.
Yeah, it's so interesting to see the hyperscalers too. So that's not taking sides. I mean, Amazon was initially an investor in Anthropic and their cloud provider. Thank you very much, Kate Rooney. As we look at the resilient market here, we're higher, not by much, but we've certainly turned around sharply from last night's futures.
Plenty to get through during the course of the week. PPI tomorrow, and then we'll get our other banks, BAC, Citi, JP Morgan in the morning.
And Invest in America on Wednesday.
Yes.
We're going to be all over. I'll join you from D.C. tomorrow. But yeah, kicking it off with the Treasury Secretary and a number of CEOs on how they're adapting to this new environment and the geopolitical landscape.
Let's get to the judge at Post 9.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The new and very busy week in the markets, earnings, and the war on investors' minds. We will discuss and debate with the investment committee, as always. Joining me for the hour today, Joe Terranova, Stephanie Link, Jim Leventhal, Bryn Talkington. Check the markets here, open lower, as you know. We've turned around, though. We're basically flat on the S&P. NASDAQ's green, Russell's green, Dow's down about 0.5%. And I have to say, guys, the plethora of notes that are out today, the ones that I've seen anyway, are like 90% skewed positive. So you've got Ed Yardeni sticking with their call that the S&P bottomed on March 30th, 7,700 on the S&P. Mike Wilson, Morgan Stanley. Much of the adjustment for geopolitical risk, private credit concerns, and AI disruptions already taken place, already in the market. Mateka over at JP Morgan. Markets could show more weakness but we stick with the view that if one has a longer time horizon, 3, 6, 12 months, one should be using the weakness to buy. In other words, buy the dip, V-shape. RBC, near term, yeah, fragile, foggy bottom, but bottom. So what do you think?
I don't think that any of us suggested when the market was trading with that heightened sense of urgency in early March that was going to be a major inflection point. And we thought we were on the beginning of a precipitous decline, something like we saw in 2022. So I agree in the theory and the perspective that everyone has. I think one of the best dynamics that ultimately has happened in the month of March is when you look at positioning. And if you think of the institutional community leans defensive right now. The systematic community, they are basically carrying a neutral bias, which means they have a limited exposure. And then we did hear about the retail community making a little bit of a bearish turn for the very first time. So I think that setup is one of the reasons why you have the resiliency in front of you right now. At a very rapid advance above the 200-day moving average. You're sitting there. So the theory and the bias of, yes, we want to be long the markets in place, but I think you still have to rebuild positioning, and that bodes well for further upside in the near term.
Why the market maintain this resiliency? Because it obviously believes that earnings are more important than oil. At least right now. It doesn't, it's trying to look past the whole situation stuff with oil, and it is focused on earnings and the economy, kind of like you have.
Yeah, I've been buying since the beginning of March, to be fair, not the bottom for sure. Better be lucky than smart. But I do think, the economy has been so resilient, led by the consumer, and the labor market, to me, has calmed down. We were so worried about the labor market softening. And while it's cooled down from the highs, certainly is solid. There's one job available in this country for one unemployed person. That's pretty good.
Do you believe what I said? Do you agree with that? Is it true? Is that the reason why the market looks like it does? Because it's more focused on earnings and the economy than the war and oil.
And I start with the economy because that's going to impact earnings. So yes, to answer your question, sure, yes, absolutely. We care more about the economy. Hanging in there, led by 70% of the economy is consumer, so we can't have that fall apart. Sure, there's problems with inflation. I got it. But they have jobs, and wages are growing 4%, and spending is growing 4%, and savings is growing 4%. All that is leading to better than expected earnings, and I expect them to be better than expected. And I think you're going to get kind of conservative guidance. It's the first quarter of the new year. It's always conservative. I think you're going to look for opportunities. I don't own Goldman Sachs, and I know we're going to talk about it, but I'd be buying that stock because that was a very good quarter. But what's the most interesting to me is since March 30th, the S&P 500 is up 7.5%, the Dow Jones is up 6%, and the NASDAQ is up 10. If you waited, and I have said this many times, if you wait for certainty, you're going to miss some of the easy money to be made. And what I also think is really very interesting, too, is year to date, the Russell 1000 value is up 5, and the Russell 1000 growth is down 5. And there has been a massive rotation, almost liquidation in growth, in some parts of growth, especially software. Not all, but some, and that's really hurting a lot of people in the psyche, I think, of a lot of people that own growth.
I think Farmer Jim, in some respects, became Jittery Jim as this whole situation unfolded. I mean, you articulated as much on this program on numerous occasions. It even formulated part of your investing decisions. I'm thinking about on holdings. Are you in agreement with the Yardeni, Wilson, Mateka, RBC idea that brighter skies are ahead and you need to focus on that? If you're always looking up at the sky for rain and it doesn't necessarily come, you're going to miss out on the sunshine.
I feel good, Scott. I do. And that's appropriate. Bring up the on holdings. You were out Friday. I did add meaningfully to BlackRock. So I'm getting in. Like, if I thought things were worrisome, I wouldn't be making that move. I think we've had great discussions from you, Steph, and you, Joe, about the importance of earnings. I would say something that fundamentally the energy market is in much better shape than you might think. And why am I saying that? Because yes, while West Texas Intermediate is whatever it is right now, I'm not going to look at the screen, $103 a barrel, Brent is cheaper. And it's cheaper than either Brent or West Texas Intermediate, Omani crude, which shot up to $160 a barrel in the heart of the conflict just a few weeks ago. These are the sort of fundamental esoteria that actually we're talking about $100 handles. But even if you look at where the most pain has been felt, the most pain has been felt in Dutch natural gas pricing. That's off meaningfully from those highs. And what it's saying is workarounds are being felt. Now, maybe for the same reason. And I'm not just going to continue talking about earnings. You already did that. That was fabulous. But if you look at things that have also perplexed us, worried us, things like high yield spreads, those have come down. You go back to January, and the Bank of America high yield index was about 265 basis points over treasuries. It shot up to 342 in the middle of March. Where is it now? 284. That is a meaningful decline. And what I'm telling you is when you lift the hood and really look at the pieces of the fundamental engine, there are things that are going right in addition to earnings.
I'm going to guess that there are a few people, at least, out there who are listening to a lot of this and saying, man, these people are too complacent. They're in denial about what is actually happening within the Middle East. The risk at this point is that it gets a little worse before it gets better. If you believe the rhetoric and some of the on-the-ground dealings there, a lack of an agreement over the weekend, what's going to happen with this blockade in the Strait. I feel like I know it. I know there are people out there who are channeling that.
But why is the market is telling you, I mean, to be up today, and I'm sorry, Joe, for the S&P to be green on the news we got yesterday, I mean, anybody who's an investor or a trader will look at that and tell you up on bad news is a sign. Don't give in. Don't give in here.
Okay, so Bryn, do you channel those that I just mentioned, or are you in agreement with those on the desk and the Yardenis and Wilsons and Matekas and gosh knows there's others out there who are just as positive on this market here?
Well, I try to be pragmatic, and I think that investors need to take right now as a learning point that history shows us, and it shows us right now, that markets adapt very quickly to the fogs of war. And so I think we've adapted very quickly. I think on top of that, if we haven't talked about yields, the 10-year seems very well anchored around 430, really hasn't moved. I think that's another big signal. We're well above the 200-day, which, that was really my biggest concern, is that we were going to stay under that 200-day for more than a month. We're well above that. And I think strategically, talking about the war, the U.S. blockading now the Strait is very smart tactically because China buys 85 to 90% of Iranian oil. And so if we have a full blockade, then that prevents that. And I've said all along, I think that China can be the player here to end this because they do need that oil. And I think that that's why President Trump said we're going to charge them a 50% tariff to try to say, hey, do not give the Iranians any missile defense. I think probably that works. And I will say on earnings are strong. What's interesting, though, this quarter, though, is Micron and NVIDIA are going to be 50% of the total growth this quarter in S&P earnings. So we're still very concentrated. And I think that's why you can't count technology out, because almost all of the earnings growth is coming inside of tech.
Joe, technically the market's gotten better. Tony P, Goldman Sachs, Pasquarello, head of their hedge fund client coverage, says the following: technical factors are supportive. Flows, seasonals, liquidity, but they constitute a guarantee of nothing when the trading environment is this fickle. I suspect that earnings will be a net positive. So he believes that. You're at 15% year-over-year earnings growth. Again, it goes back to how we began the conversation. The market obviously is more focused on the Pasquarello perspective than whatever is fluctuating in the world's energy markets.
And the anticipation is, as you go through the course of 2026, the earnings growth actually will rise closer to 20%. So to Bryn's point, to my earlier point, the bond market is calm. Steph mentioned before the relationship between growth and value equal weight S&P 500, 100%. I'm in total agreement, and I want the S&P equal weight to perform well. But since the March 30th intraday low for the S&P 500 at about 63.16, growth is outperforming value by about 8% S&P, and you want to see that because that's confirmation that we're seeing positioning go back to where the market first saw the reduction in the positioning and the challenges and the concern. And the market is validating where they believe that they will find the more reliable earnings growth.
Yeah, but I think the debate that needs to be had between you and Steph, because it sounds to me like you're making the case that you think that the makeup of the market has changed. The war has changed it back to now a more growth-oriented environment from what was working before, which is why you had the broadening, which is why Steph can read off the stats she did about value outperforming growth. Right. I hear you making a case that you think that's going to be the new normal now, whereas I think Steph is trying to make an argument that she thinks we're going back to the broadening story again.
But yet, you know what's the most interesting? In this downdraft, the most names that I've bought has been in technology. Some hardware, some semis, some software, getting hit there for sure. That's not an easy play, but I do like the valuations there. So I think it's not all or nothing, Scott. I think we find sectors, we find stocks where profits are going higher, because I think it's as simple as stocks follow profits on the way up and on the way down. And that's one of the reasons why we did so well these last 3 years. Yes, I know the last 3 years it was very concentrated. It doesn't matter. Earnings were going higher. As a result, I think this year is the same, but maybe the makeup is a little bit different. It's broader because the economy is doing
right. But go respond. So, I feel like you're making the case. You wouldn't have brought up the stat of value out growth if you didn't think that that's how it was going to continue.
Maybe some of the software and technology names that I'm buying actually are value, Scott. That's the whole point.
Growth that has become value, I think is so. I think what's important to understand is we've recalibrated the valuation on the technology growth story for sure. Just look at the Max 7. The forward multiple went from 30 to 24. So you have that recalibration in terms of valuation. A lot of these technology growth names look far more appealing. I do think in the near term, you are going to continue to see a rebuilding, first and foremost, in positioning for growth.
Well, okay, how about this?
I think you'll see that.
Say, look, I mean, there's a big story here that we're not talking about. We all know it. The whole AI food chain. That's not going away from a war. In fact, it's increasing for security purposes. But the food chain being data center, power grid, we talk about it all the time. And that's not changing. In fact, it's accelerating. And that's a big driver of the value trade. Industrials are benefiting. Financials are benefiting. There's a lot of industries that are benefiting from that theme. And that has only accelerated.
Let me just bring another statistic in, because it backs up what you said about where valuations have compressed to. Torsten Slok at Apollo says today valuations are back to the pre-AI boom levels. They've compressed from 40 times to 20 times as a sector, levels seen before this whole AI boom happened. That's probably playing a large role as to why growth has outperformed recently, because there was such a valuation correction at the same time where I think people have a more confident and consistent view of where the earnings growth is going to come from, albeit Bryn mentions two stocks in particular that may make up the largest portion of it. It's still coming from that area within the market rather than from others that are more directly tied to the cyclical nature of the economy.
Without question, I think that is what we have seen so far in the first several weeks of April. Steph's mentioning the industrials, a lot of really strong businesses with great balance sheets and clearly defined as I look at it, as quality, but they have also, over the last several years, become more growth oriented. We took a position in Trane Technologies in October of 2023. It's speaking to exactly what you're identifying, the AI infrastructure build out as it relates to cooling for data centers. Well, guess what? Trane Technologies, we look at that stock now, we think it's a growth company.
Well, it's initiated outperformed today at Evercore. 535 is the target there. And there's also, as Steph was talking about, there's some calls on the data, the power-related plays. We'll get to those a bit later.
The transports are doing quite well too. That's indicative of the economy doing better. That's cyclical.
How about
They're
this?
doing better.
How about this stat, Bryn, from Jeffrey's trading desk? Tech Momentum just had its strongest 10-day move in 25 years. And the best week since the COVID vaccine was released in December of 2020. Meta posted its best week in some 2 years.
Yeah, I think that this setup has a high probability of continuing going into the earnings of Meta, of Google, of Amazon, maybe Apple, maybe Microsoft, because these names have been penalized for CapEx, by the way. That is the reason why these multiples have come down, because people question, is the CapEx spend good? But now at a valuation level, you can say, hey, the earnings power is still there. And so I think these are going to be really strong names to own during this earnings season. So I think it's a really good setup and a really good note.
All right, Goldman kicks things off today. As everybody at this point knows, the stock has been down after their FICC trading revenue was a miss. Stock's down 3%. It's off of the worst levels. B of A reiterates it a buy after the result. They had equity trading, they had record revenue, and they had a 48% increase in investment banking fees. You own this name personally, right?
I've owned this name since April of 24. I will continue to own this name. I hope Steph joins me in owning Goldman Sachs, because I think it's going to continue to move higher. If you listen to the call, David Solomon talked about the analyst community who maintained very high expectations for this company, rightfully so. Remember how it came into this earnings report as one of the leading financial sector names, as one of the leading money center banks. You didn't see significant reduction in terms of sentiment and positioning for this company. So now let's go underneath the surface for the earnings. We understand that equity trading was ridiculously strong. JP Morgan reports tomorrow. Probably going to see a very similar type of dynamic there, strong equity trading. Did anyone think that rates and mortgages was going to be the standout for Goldman Sachs or any of these banks?
I totally agree with you on that.
So that was the problem. Dig in, do the homework on what the earnings really were. Commodities and currencies were fine. The significant contributor to the underperformance in FICC came from rates and mortgage, and that's understandable.
Mayo at Wells Fargo Securities says underlying trends seem unusually strong in investment banking and equities. A good beat may fall short of expectations for great. That's how he characterizes it. But Steph, you look through the Goldman to others, and you come away with what when you own Bank of America, Wells Fargo, and Morgan Stanley?
First and foremost, these stocks have all rallied 10 to 15% off of their lows, so a little bit higher expectations, which is never really a great setup. But if you go through advisory up 89%, equities up 27%, asset and wealth management up 14%, those all bode well for all of the big six banks. And I expect Morgan Stanley to do very well, especially on their ROTCE. That was the thing that got my attention with Goldman, because it came in at 21.3%. That is amazing improvement that they have seen. And I think Morgan Stanley had the highest ROTCE this is profitability metrics. They had the highest one last quarter. I think they're going to continue to see good growth there, and that's really very important. But I think all of the metrics are very positive for the banks.
Joe, you've been all over the exchanges trade. Talking about it reasonably early, too. Well, Deutsche is on the bandwagon as they include Intercontinental Exchange, ICE, parent company of this place, as one of its top picks, along with BlackRock and Schwab.
Relative underperformer when compared to CME. I think CME is up about 11% for the year. ICE is basically flat on the year. SIBO is up 18%. That's another name that I think you want to own. But when you see this continued elevated volatility, when you go out and you read that companies, private companies like Citadel and Jane Street and Hudson River are earning more in a quarterly basis than Goldman Sachs and Morgan Stanley off of trading, you understand, well, I need to own Interactive Brokers. I need to own Schwab. I'll say it again with Virtu Financial approaching $50 as an all-time high. I don't have a position there. I have a personal relationship, but it is the one publicly traded market maker that you're able to allocate towards when you see a lot of these private companies earning the revenue that they're earning. And the volatility, Scott, it's not going away. Does anyone think the volatility is going to diminish significantly? Are we going to go back to where we were in 2023 or 24? I don't think so.
BlackRock included in the Deutsche note, Jimmy, as top picks. Schwab, BlackRock, and ICE.
BlackRock got sold off quite a bit, at least in part because of their HPS subsidiary that they bought a few years ago, which has a lot of private credit in it. That's such a small part relative to the overall business that is BlackRock. that I saw the opportunity, and as I said, I added to that on Friday. Scott, it's not a call on this quarter's earnings. It's a call on BlackRock over the coming years, having many pistons in its engine that are going to keep firing. The iShares, the multi-asset class, and yes, the private assets as well.
Take a look at Oracle. If we
yes, take a look at Oracle.
Stock is a rip today. I guess on some headlines coming out of a summit that they're hosting, the stock's up 10%, but software, a lot of the names in here today, Intel's up almost 4. Names like CoreWeave are up 8 1/3. You have some pretty good. Microsoft is up. How often do you say that? It's up 2.5%. But you kind of get the point because the stock hasn't traded well. Cyber, Palo's up 3. CrowdStrike's up almost 6. Dell's up 5 1/3. Jimmy?
I think, simply put, enough is enough. The software stocks in particular, and the software adjacents like in Oracle, they've just been sold down too much. I don't think Oracle is up on the headlines. I mean, I've read the headlines. They're not that interesting. But what I said earlier about high yield spreads does matter. And we know about Oracle's debt position and how much it's increased, and the credit default swaps, which are off about 20 basis points over the last few weeks. They're still very elevated, make no mistake about it. But ultimately, enough is enough, and I think this is a delayed reaction to things like OpenAI, which raised over $100 billion in their latest round, which starts to put to bed some of these fears that it won't be good for the $1 trillion plus of commitments that it's made.
There needs to be like more than one day's activity for others to believe that enough is enough. Wolf today says the downtrend is alive and well. Bryn, Jonathan Krinsky, BTIG. Let's show up the. Let's put up the IGV, if we could, guys. It says 77 is key, so we're a buck above it. 77 was a huge level. He says as long as it's below that, we continue to see risk towards 70. Intraday move, not so important. Not so interesting. We'll see where it closes at the end of closing bell today. If it can stay above that line in the sand, the Krinsky line in the sand. Bryn, Palantir, worst week in over a year. It's coming off of that today. How do you see this group?
I think, well, if you're part of IGV, unfortunately, you're going to get lumped together, right? So whether you're Microsoft, Oracle, or CrowdStrike, 3 different companies all lumped together in the IGV. I think Palantir, the thought that Anthropic is a competitor to Palantir, which has been part of the narrative, to me doesn't make any sense whatsoever over the next 5+ years. And so I think that Palantir, it needs to settle down, though. We talked about this last week. It's still an incredibly expensive stock. And so how do you value the company? And so to me, I still have a small position. You know, I originally bought it at 25, sold some at 45, 75, and 100. And then I have what's left because I do understand and respect the valuations. And so I do think it's going to settle in here. But I don't think that this competitive Anthropic versus Palantir makes any sense because Palantir actually uses all of the AI companies. They're neutral on them, and then we'll use them as they see fit. So I still think from a software company, it's expensive, but they are the original AI company. They have great enterprise. They have great government contracts. So I think once it settles in here, buyers will come back in spite of the valuation.
Joe T.
We had a significant reduction in our holding of software at the end of January. We're down to 5 names. I'm not sure about Microsoft and Oracle. I maintain your perspective where I don't think one day is enough. I agree with Bryn on Palantir. That is a name you absolutely want to watch. Steph, you might like Cadence Design Systems.
No, I own Synopsys.
Okay.
It's cheaper.
It is 100% cheaper for sure.
You have Cadence, right?
I have Cadence. I think Cadence. They both work well in the narrative of the software designed for semis. And then lastly, Bryn, you're going to feel great about Zoom when I tell you I liquidated Zoom because I had it personally, and in the ETF I liquidated it after earnings. I'd love to get back in. It is the play on Anthropic. People don't understand the demand right now is insatiable for Claude. I'm using it myself. If you want a publicly traded mechanism to get some exposure to Anthropic, it is through Zoom.
All right, we'll take a break. We'll come back, we'll do our top calls of the day. Got another downgrade for a struggling consumer name, a pair of upgrades in the housing space. We'll trade all of it when we come back. right, welcome back. Take a look at shares of Starbucks, if you could, please, because there's a call on it today from Jefferies. Stock is flat. They raised a target to 92. They had it at 86. They also had an underperform on that name. Can you pull the chart out more, please, to like, I don't know, 3 months maybe? I think it's a better perspective on Steph. Steph made a call on this name, right? Like a few months back, handful of months back. Can you put that back up, please? Up. There you go. Thank you. 3 months up 7%. Obviously, you had a dip late last week. So Jefferies goes to hold from underperform. You had already taken it off underperform and put it on a reasonably strong buy.
Yeah.
What did you see?
It was down on the year when I was buying it, and I just can't believe that that would be the case with Brian Niccol, the CEO, running this company. So it's now up 14% year to date. So it's been a nice performer.
Oh, that's a better chart. Then let's look at year to date while you speak.
I think that they're focusing on culture, they're focusing on execution, new products, and that they therefore think they can get to $4 in earnings power by 2028 and 3% sustainable same-store sales. This company has had negative same-store sales for the last couple of years, so I think that we're just beginning to see the turn. And the biggest interest to me is the operating margins. I think you can see back to 17-18% over time, so real operating leverage.
Where'd you buy it at? Do you remember? Like ballpark? If it's 96.5 now?
Probably I think in the mid-80s.
Okay. No, it was a big call when you made it, and I know you talked about it on CNBC Pro.
I did.
At the time, too, which was great for everybody to get the perspective at the time of the buy. And then now you see the results, a reasonably short period of time, but nonetheless up since. Estee, target goes to 120 from 130 B of A. They still like it. They just take the target down.
This has been incredible. This went from a turnaround story, which you know I love, to a transformational potential M&A transaction, which could have pro forma revenues if the combined companies do merge of $21 billion. I know why people don't like the deal, because it's down 25% since they announced. They didn't even announce the deal. They're just talking to each other right now. It's down 25% since then because people wanted the turnaround. And this would be a very big transaction under this fairly new leadership team. I think this would expand their markets, their categories. I think there'd be lots of synergies as well. So I'm sticking with it.
Speaking of fairly new management teams, Bryn, analysts just think that Nike keeps tripping over its own shoelaces because it got downgraded again today. This time by HSBC, it's to hold from buy. They had a $90 price target that they've basically taken in half. They're at 48 now. Stock's only 42.5. Global outlook for sporting goods remains challenging. Now it's funny because there's bullishness on Dick's Sporting Goods, but nonetheless, that's what they say. They point to weakness within Converse. They point to weakness within China. I think that was underscored in the most recent earnings report. Emerging markets and emerging Asia, EMEA, and sportswear continues to weigh on the business recovery. You sold it back in February.
Yeah, well, I had bought Nike and On shoes because I thought the Supreme Court, it was a high probability, would come out and say, well, the tariffs were not legal. Neither stock really moved, and so I moved on because that was the reason why I bought it. This stock, though, has been a complete disaster, and if you've bought it, your hands are all cut up because it has been truly a falling knife. And so I just think that they lack execution. They always have a great CEO that's trying to turn things around. But I always tell our team and my kids, you don't have to make it back the same way you lost it. I think this is a really tough name to own, and there's so many other companies that we've talked about for the first 30 minutes that you can add returns to. So I don't know why people anchor in on stocks that just seem to be a mess. Just move on.
Okay, Williams-Sonoma up to buy at Goldman. Price target to 218 from 185.
Yeah,
Joey.
Makes sense. You really need to hear from them at the end of May when they release their earnings. Since the prior earnings report, the stock has kind of moved sideways to lower. E-commerce, 60 to 70% of their business. This is a company that's seeing really strong momentum in Pottery Barn. They need to have an improvement in home. and that relates to the one area of the economy that just is the laggard, and that's housing.
All right, Seema Modi has our news update today. Hi there.
Hey, Scott, the U.S. military says it struck 2 boats smuggling drugs in the eastern Pacific Ocean, killing 5 people and leaving 1 survivor. The Saturday attack brings the number of people killed in boat strikes by the U.S. military to at least 168 since the Trump administration began its crackdown in early September. Now, the U.S. Southern Command posted on X saying the boats were traveling along known narco-trafficking routes. In other news, more than 1,000 actors and directors releasing a letter opposing Paramount's acquisition of Warner Brothers Discovery. The letter was posted to a website called Block the Merger and says the deal would decrease job and creative opportunities across the industry. It was signed by some big names like Bryan Cranston, Emma Thompson, and Ben Stiller. Finally, Delta Airlines unveiling the first update to its long-haul Delta One suites in nearly a decade. The suites will include beds that are 3 inches longer than the older suites and will give travelers more leg and knee room. Delta says the updates will debut in 2027. Scott, I'll send it back to you.
All right, Seema, thank you. That's Seema Modi. Still ahead, your ETF edge. Dom Chu tells us what is coming out. The backdrop's not the same as it was last week, but it's all right.
It's all right, and there's some rotation happening, Scott, to your point, given all that recent market volatility. So are there certain specific areas of the market that are seeing relatively higher demand versus others? We're going to speak with the CEO of one ETF provider for what investors are rotating in and out of. That's coming up next for your ETF Edge right here on the Halftime Report. Welcome back to the Halftime Report. I'm Dominic Chu with today's ETF Edge. Now, with the breakdown in negotiations in the Iran war, investors are now facing protracted impacts on domestic economic conditions. So how are ETF investors repositioning? Joining me now for that conversation is Christian Magoon, CEO over at Amplify ETFs. Amplify is a shop, Christian, that has become known on Wall Street as having a thematic kind of approach or suite of products. What exactly are you seeing right now with regard to the market volatility and how investors are moving in and out of the markets?
Yeah, definitely a move away from higher beta equity plays like technology, looking more at hedged equity plays that kind of can limit some of this volatility during all these headline events we're having right now.
Now, when you say hedged equity, it's one of those situations where they use options and other derivative activities around portfolios, right, to kind of buffer movements.
That's correct. So it's using covered calls or maybe dividend-paying stocks to give you a cushion of 5, 10, 15% to the equity market, but still add to your total return through this income stream.
Now, what types of parts of the market are you seeing some of the most activity? Where are investors gravitating more towards and perhaps a little bit more away from?
Yeah, so surprise, surprise, energy is the big winner this year sector-wise. So we've seen a lot of exposure to hedged energy, for example. So we have an ETF NDIV that offers a 10% income stream, but also capital appreciation. That's been up about 30% this year. We're seeing people move away from some of the more volatile technology names simply due to some of the concerns about liquidity, Fed raising rates, or maybe just the economy tipping into recession here with oil prices.
And one quick point here, how much is crypto being affected by the market volatility?
Well, it's kind of removing some of the liquidity from crypto. In addition, the other L word, legislation, isn't really progressing. So that's hurting crypto a little bit. Seem to be in this chop range of 65 to 75 for Bitcoin.
All right. Now, we're going to continue this conversation over at etfedge.cnbc.com. Christian's going to be joined by Jamie Harrison, the head of ETF Capital Markets Trading over at MFS. So keep an eye on that show. Scott, I'll send things back over to you.
Dom, for the record, I was referencing that beautiful Augusta backdrop when I tossed it to you.
I did get to see some of it in person this past week, so I will say that, you know, it is as billed. It's even more beautiful in person than on TV.
I would only hope that you stayed a bit. Dom, thanks.
You got it.
Coming up, we'll give you that trade on healthcare. This is a really, really big moving stock today. It could have some ripple effects and some other names you want to take a look at. We're following that money next. Let's listen.
We agreed to a lot of things, but they didn't agree to that. And I think they will agree to it. I'm almost sure of it. In fact, I am sure of it. If they don't agree, there's no deal. There'll never be a deal. Iran will not have a nuclear weapon, and we're going to get the dust back. We'll get it back. Either we get it back from them or we'll take it.
Mr. President, as far as the naval blockade is concerned, what's the end game to force Iran back to the negotiating table? Is it to open up the strait so the gas prices ultimately come down?
Maybe everything. I mean, both of those things, certainly, and more. We can't let a country blackmail or extort the world, this is going to be settled before that. We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal.
Is it your anticipation, Mr. President, that other countries will assist in this effort to blockade Iran and those?
Yeah, other countries are going to also. We don't need other countries, frankly, but they've offered the services. We'll let it be known probably tomorrow.
Has the blockade started, sir?
Yeah, started at 10 o'clock. No, I don't, because Pope Leo said things that are wrong. He was very much against what I'm doing with regard to Iran, and you could not have a nuclear Iran. Pope Leo would not be happy with the end result. You have hundreds of millions of people dead, and it's not going to happen. So I can't. I think he's very weak on crime and other things. So I'm not. I mean, he went public. I'm just responding to Pope Leo. And you know, his brother is a big MAGA person, and he's a great guy, Louis. And I said I like Louis better than I like the Pope. Now, you have to have law and order in our country, and that's what we have now. We have the lowest crime numbers we've had in a long time, despite the fact that many criminals were allowed into our country, but we've gotten a lot of them out. We've done a great job on crime. So we have the lowest murder rate in 125 years, since 1900. The lowest murder rate. So we believe strongly in law and order, and he seemed to have a problem with that. So there's nothing to apologize for. He's wrong. And the other thing is he didn't like what we're doing with respect to Iran, but Iran is wants to be a nuclear nation so they can exterminate the world. Not going to happen. Yeah, I don't want to comment on that, but it won't be pleasant for them. Let me put it that way.
Do you still plan to charge Has your timetable changed in any way in terms of ending this conflict?
No, I wouldn't. It's going on. Just right now, there's no fighting. Right now, we have a blockade. They're doing no business. I didn't like seeing boats come out if they were doing business with Iran, but if they weren't, no boats came out. So now, Iran is doing absolutely no business, and we're going to keep it that way very easily. Don't forget, their Navy is gone, their Air Force is gone, their anti-aircraft is gone, their radar is gone, and their leaders are gone. That's a lot.
Do you still want to charge them from predominantly going to China, Mr. President? Has Xi Jinping reached out?
No, but we have a very good relationship with China. He would like to see this ended also. He certainly wants it ended. Everyone, I want to see it ended too, but we can't give a nuclear weapon to a group of people that have caused nothing but havoc for 47 years. Look, I'm the president that's done something about it. This should have been, and many other presidents regret that they didn't. Yeah, so I'm doing something about it.
Ukraine impeachment documents that were just declassified show that Eric Charanella not only submitted false information, but that he had no direct knowledge of the alleged conversation on hearsay. Do you feel vindicated by those?
Yeah, I do. They're a bunch of crooked people. You're talking about with respect to all of the things that they put against me. Yeah. Well, it's come out that in so many different ways. Thank you very much for that question. I appreciate it. But in so many different ways, the election was rigged. The 2020 election was rigged. We found that out. What you just said is just a piece of that. It's a big piece, but minor, relatively speaking, compared to what they did. They cheated on the election. They cheated on the vote. And they cheated in every way possible. And it's the only way we got an incompetent man to be a president. And he was an incompetent man. Many of the things that we're talking about, even including this would have been settled a long time ago, not now. And it should have been settled by other presidents. But the election was a rigged election. We can't let that happen to our country. Well, it's a very serious charge against them and the Democrats. They cheat. They can't get elected with their policy. So their policy is no good. They want to have, open borders. They want to have men playing in women's sport. Do you think that men should play in women's sports?
I really don't have an opinion on that.
You don't, I'll bet you do.
No, I'm here about
Pizza.
no tax on tips.
Yeah, go ahead, please. think they're doing very well here. You know, a lot of tankers are coming up here. They're coming in empty and out full. And we have a great capacity to take care of that business.
May we know your name, please? Have you delivered to the White House?
I have not. My name is Sharon Simmons.
And the White House good tippers, do you know?
Wait.
Yes, very.
Thank you. You reminded me.
Mr. President, one on Cuba, sir. You previously said that you had no problem with countries sending fuel to Cuba after previously imposing tariff. What happened?
Well, we're going to see with Cuba. With Cuba's another story. Cuba's been a terribly run country for a long time. It's got a bad system. It's been very oppressive, as you know. And we have a lot of great Cuban Americans, all of whom just about voted for me. And they were treated very badly. In many cases, family members have been killed. They've been beaten up and mugged. And, like, terrible things happen in Cuba. And Cuba's a failing nation. And we're going to do this. And we may stop by Cuba after we're finished with this. But Cuba is a nation that was just been horribly run for many years by Castro.
You said raised housing regulators don't compete. Regardless to recent referrals from Letitia James for an insurance fraud, do you know if federal prosecutors have evidence?
Well, I don't know. I know she's a very corrupt person. And you're talking about the so-called Attorney General of New York. She's a very corrupt person. That's been proven now. And I know I have nothing to do with it, but they're looking at things all over the place, more than one state concerning her, and concerning people like Comey, who's a dirty cop. Comey's a dirty cop, and dirty cops are bad. Nobody likes the police more than me, law enforcement more than me, but Comey's a totally dirty cop, and we're not gonna stand for it. Yeah.
UFC fight that's happening at the White House this summer. UFC typically numbers those fights consecutively, so should they enable this for the UFC 17?
That's a good idea. I'll tell that to Dana White. I like that idea, actually. I will say I've been involved with a lot of big events. I've never had an event that's had more interest in the UFC.
We'll take it back. The president still speaking with reporters just outside of the White House there on the situation with Iran. The blockade has started of the Strait of Hormuz, he said. Iran would like to make a deal, no deal without an agreement on nuclear. Those are the refrains that really matter, certainly to the market at the current time, which, by the way, has green now across the board. Megan Casella for us is in Washington with reaction to what the president has just said regarding the unfolding events in Iran. Megan?
Scott, that's right. You hit the highlights there. And I would flag just one more that we hadn't yet heard, which is that he said he'd been called this morning by what he described as the right people, and that they would like to make a deal. So that's the first that we've heard that the president sounds like has been in touch with the Iranians, or at least with mediators this morning, potentially since that blockade began, and that there could be further movement towards a deal. He did sidestep a question about if there was another round of talks planned, saying, again, just that there had been a call on the nuclear material. He said, we'll get the dust back. Either they'll give it back or we'll take it. So as he totally firm to that idea that Iran cannot have a nuclear weapon. He was asked what happens if there's not a deal by the end of the ceasefire. Scott, remember that expires just a little over a week from today, next Tuesday. He said he didn't want to comment on it, but that it wouldn't be pleasant for Iran to keeping up those threats. And he described the blockade a little bit. He said Iran is doing absolutely no business now, and we're going to keep it that way. Just one other point, not quite the top headline here, but he was asked if China's President Xi Jinping had reached out. He said no, but that he did have a very good relationship with China, that China's Xi Jinping wanted to see this ended, and that President Trump said he does as well, Scott.
Okay, Megan, thank you very much for that. That's Megan Casella in Washington for us. We'll take a break. We'll come back after this. See you for the last hour of trade on Closing Bell. The professor, Jeremy Siegel, with me. Dan Greenhouse is as well. Malcolm Etheridge joining the conversation. Jonathan Krinsky, Matt Foss, Ankur Crawford. Great lineup, and I hope you'll join me at 3 o'clock Eastern time. We are still, I think, green across the board. We'll check that. Yes, we are. So we'll have an interesting one for sure. Bryn, do you have a final trade for us?
CBRE stock went down almost 40 points off some cloud plugin. I think it goes back up to 173.
Okay, thank you very much. Farmer Jim, is that you with Citi?
That is me. I don't normally step in front of an earnings day like I am with Citigroup.
Do it.
I am, my brother. I am, Your Honor. Aye, sir. This stock, the market wants it to go higher, and if something goes wrung, you're still going to want to own it.
Back to Farmer Jim. Don't be Jimmy Jitters. Do it.
We've wiped that off the board.
We've drank some water. Steph, you already crushed like 3. I don't know. We have the water can up there yet? What's up with that?
I'm going to go with Morgan Stanley after Goldman Sachs report. I feel really confident it's going to be a good one with better ROTCE. Stock is flat year to date, trades at 15 times earnings, a 2.5% yield with a ton of excess capital. That's coming our way.
All right. Joe, is that you?
It sure is. XBI. Revolution Medicine.
Yeah, oh man. Show that chart. We didn't get to it today, but show the chart as he's talking
that's
about
1% of the XBI ETF. But deals are happening in the space. This could be the best year since 2019 for M&A.
There we go. Good job, guys. Thank you. We'll see you on the bell.
Scott, thank you. Welcome to The Exchange. I'm Leslie Picker in for Kelly Evans today. Stocks paring losses at this hour, but still not making much headway, with the president confirming a few moments ago that a U.S. blockade of Iran's ports is now in place. The Dow, the relative underperformer, Goldman Sachs, a big reason why, and more on that ahead. Software rebounding today. The IGV software ETF up more than 4%. Oracle leading the gains up 10% and on pace for its best day since last September. And we're closely watching the price of oil as we do every day now. Crude had been up as much as 8% to $104 a barrel earlier, but now back down, hovering right around $100 level. And Iran is where we start, with the president addressing reporters at the White House a few moments ago. Megan Casella is live in Washington with the latest. Hey, Megan.
Hey, Leslie, that's right. President Trump telling reporters just a few minutes ago that the U.S. has heard from the Iranians this morning and that the Iranians want to make a deal. The president, speaking with reporters, sidestepped a question about whether another round of negotiations was planned. He said only that the U.S. had gotten a call from what he described as the right people. News of it, though, comes less than 3 hours after the U.S. began blocking all maritime traffic entering and exiting Iranian ports and coastal areas. So here's what we know about that blockade. It will be enforced in the Gulf of Oman and the Arabian Sea, east of the Strait of Hormuz. U.S. Central Command says that any vessel entering or exiting the blockaded area will be subject to interception, diversion, and capture. But the U.S. will not be impeding neutral traffic to or from non-Iranian destinations. That said, though, the Iranians will be. An Iranian military spokesperson saying in response to the U.S. actions that if Iranian ports are threatened, then, quote, no port in the Persian Gulf and Sea of Oman will be safe. But for now, Leslie, the fragile ceasefire does remain in effect. Both sides, though, are suggesting a willingness to return to military action if necessary. Before he spoke with reporters, President Trump this morning was warning that any Iranian ships that come anywhere close to the blockade will be immediately eliminated using the same system of kill, he says, that we use against drug dealers on boats at sea. Now, a spokesperson for Iran's Ministry of Defense later said that any military intervention by foreign powers in the security of the Strait of Hormuz would escalate the crisis and instability in global energy security. Leslie, so much more to watch here, but at least some news that the two sides are now in touch.
Yeah, it seems very tenuous indeed, Megan. What happens here in terms of next steps, assuming that things don't worsen and escalate?
You know, we don't know. For all the action over the weekend, there wasn't any update to the timeline. The ceasefire as of now is set to expire next Tuesday, the 21st. The president was asked if there was another round of talks planned. All he said was that the other side wants to make a deal. He was asked what happened if there weren't any sort of deal reached before the end of the ceasefire. He said he didn't want to comment on it, but that it would just be very unpleasant for the other side. There has been some reporting from the Wall Street Journal and others about whether the president was looking into military actions potentially before the end of that ceasefire. No confirmation from the White House on any of that. The last most concrete thing we heard from the president himself was in a Sunday interview. He did sort of renew threats on Iran's infrastructure if there weren't any sort of a deal reached. So they're kind of preserving their options, and we just don't know yet if the diplomacy or military will be the next step forward.
Yeah, the potential to escalate militarily versus, continue these diplomatic talks. Megan, thank you. Megan Casella for us. Crude coming off the highs and now below $100 a barrel. In March, my next guest said the ongoing loss of energy supply to the global economy is so large that it simply must be solved either militarily or diplomatically. And he expected that it would be done by mid-April, which is, today, now. Well, we are in mid-April. Talks have failed and a blockade is in place. So let's ask him how that timeline has changed. Let's bring back Citi's global head of commodities research, Max Layton. Max, thanks for being here. So it is mid-April at this point in time. The two sides still seem to be pretty far apart on the major issues. What do you think ultimately gets them over the finish line, especially given, as you mentioned, the necessity of the world's oil supply and the ability to traffic through the strait?
Yeah, I mean, in some ways they seem pretty far apart still, but it's possible. President Trump talked about it today. It's possible, and the fact that they met, both sides, U.S. and Iran, the regime met with the U.S. delegates over the weekend, it suggests that after facing the kind of worst possible escalation, which was mutual energy infrastructure destruction, that both sides didn't want to go there. That meeting itself kind of suggests that, I wouldn't say the worst case is off the table, because we could certainly still go there, but with facing that, both sides meeting, this suggests that we're heading towards a deal of some sort. Having said that, it hasn't happened yet. Both sides weren't ready to make the deal over the weekend, and now we have kind of like a mini escalation at the moment, a testing of the ceasefire. Both sides seem to have different takes on exactly what was agreed on the ceasefire, and I haven't seen anything written down, so we're kind of testing that ceasefire at the moment. But yeah, look, the good news, I guess, is, and the equity market seems to be looking at that good news side of the coin, that the kind of mutual energy destruction scenario is neither side wants that.
So how then are you handicapping the likelihood of a major escalation, especially in light of the reports that say that the U.S. side, at least, is preserving all optionality on that front, the Iranian side as well? Given that talks did take place, do you still think a potential escalation is a tail risk at this point?
So yeah, our central case scenario near term is that things are escalating in a moderate way, and then we have like a bull case scenario, which is that they remain, that the disruptions on the Strait remain for months, or we have the kind of the worst case mutual energy destruction in the region. The base case, both of those scenarios are bullish, and we put an 80% probability on them in total. So 50% central scenario, 30% bull case. So near term, we're kind of set up that this gets worse before it gets better. You mentioned at the start that we said that we were expecting it would get better central case by mid-April. We kind of extended that to mid to late April. So we've got a couple of weeks in this central scenario still. And yeah, look, it's still the base case that, yeah, it gets worse before it gets better. It goes moderately higher. We've got it going to 120 on Brent, front month contract in the next, now in very near term, over the next week or so. And then the situation improves significantly. But, we're certainly not out of the woods yet. And I would say, we're still very concerned about the situation.
How are you thinking about which side has the leverage at this point in time? Because you think about just the overall policing through the Strait, and all it takes is one of the actors to say, no, we're not going to let this happen, and no one's going to move forward if they can't ensure their own safety. So, what does that mean for just the overall picture of leverage to get through this, to get through the diplomatic talks and come up with some sort of a resolution here?
Yeah, the move to blockade the Strait is an attempt to gain some leverage over Iran. And I think the administration's been, we don't know what's going on behind closed doors, but publicly been pretty clear in saying that one of the core objectives, or one of the most important objectives, is the nuclear situation. So I think some further give on that from Iran, and some further give from the US, and we can have a deal. I think that's what this leverage is trying to create. Whether or not it works, it's just super difficult to call. It's super difficult.
Absolutely. Well, we'll look forward to the next 2 weeks. Hopefully that leverage comes front and center, and there is some sort of a resolution here. Citi's Max Layton, appreciate your time today.
Thanks.
Let's turn now to the markets, with stocks recovering losses as the major averages all turned positive after those comments from the president. But my next guest says the risk to the markets is still to the downside, and it's okay to be late to the rally. Joining me now is David Hardin, CEO and Chief Investment Officer at Summit Global Investments. David, it sounds like you believe there's some asymmetric risk at play here. Why do you think it's more tilted to the downside?
Well, Leslie, thanks for having me on the show. Again, I appreciate being here. The market is always able, in the long term, I think, to climb many walls of worry. But in the short term, there's a lot of volatility and there's a lot of risk on the table. And so I think being in the right stocks and having the right combination of stocks, holding the ones that make sense and have high profitability and high earnings, probably a good play. And getting rid of those that are creating more volatility in your portfolio is what you want to do here. So managing risk is key in this environment.
But it does still feel like the path of least resistance, assuming no bad news, is to the upside for equities. Is that a fair characterization of sentiment?
I think there's some really good equities out there that you could pick through and say, absolutely. As a whole, it doesn't mean that you're out of your equities. It just means that you need to manage them better. I think you need to have a protection side in your portfolio. Not overly defensive, not all defensive, and certainly not all out of the market, but you need to manage risk. And that's really, really key for investors. Investors, let's face it, downside returns or negative returns hurt way worse than upside.
Absolutely. So what specific stocks do you think fall into that characterization, both in protecting the downside, and then how would you balance a portfolio or hedge a portfolio amid all of this volatility?
So first, I think the ceasefire, just going to that real quick, is something that we definitely should pray for, but it doesn't seem inevitable. And so having that in your back pocket and knowing there's some volatility that's still going to play out, I would look for a company like Microsoft as a really good company that has, I would think, very high quality earnings, a high profitability. It has a low PE right now around 22. It's off significantly from its highs. And so over a 3 to 5 year, its average PE has been about 33. So I think its earnings yield is around 4% plus. This is a company that where if you're looking for some, it's already off its high, some ability to kind of weather the storm. This is a company I would look to right now in the portfolio.
And in terms of portfolio allocation, obviously you've got the commodity side of things with energy continuing its move higher. How do you think about just the current geopolitical environment and setting aside an appropriate asset allocation?
Well, I think that the environment's very volatile. And we said about a month ago that people should have some exposure to energy, because if things go really bad, energy is going to continue to go up. So it's right now acting in some ways as a counter market to the volatility that's out there. The risk is that there's a downside there. And if the ceasefire holds and things happen and your prayers are answered, then hey, we have a lot of opportunity to get out of energy. That's why I think from an asset allocation perspective, you do need to have some still, definitely for long-term investors and even mid-term investors, allocation to equities. And in your equities, I would say one of the stocks that you have to have a little bit of risk on the table is Micron. Micron's a stock that's off today. It's a stock that's been off its highs, but its growth rate of over 300% earnings per share growth rate is tremendous. Its PE is still around 7. This is a stock, if you're going to take some risk in your portfolio and have some equity exposure and maybe want to play with a little bit of your money, that's a trade that's worth looking at.
All right, David Hardin with Summit Global Investments. Thank you so much for your time today. Coming up, Goldman Sachs lower despite a beat on the top and bottom lines, but posting big declines in one division, and that's hitting sentiment. The details and what it means for the rest of the banks on deck to report. Plus, Microsoft, the standout gainer in the Mag 7 today. OpenAI throwing some shade at the tech giant, but Bernstein still calling it one of their favorite AI names. The analyst joins us to make his case. The exchange is back after this.
This is The Exchange on CNBC.
you take a very tough cycle, the global financial crisis, the cumulative default rates across the entire leverage lending space during the global financial crisis was 10%. Recoveries were about 50%. So the cumulative loss was 5 to 6% against coupons of 9 to 10%. And so that is the business model of this. I think institutional investors understand that. I think there's going to continue to be, some noise around the retail space. I think you should watch that carefully.
That was Goldman CEO David Solomon answering the question our next guest had on the bank's earnings call about private credit and what the recent turmoil means for the firm's growth outlook. Joining me now is Ibrahim Poonawala, head of North American Banks Research at BofA Securities. Ibrahim, good to have you here. And I wanted to start with private credit. I thought your question was a really good one because it has kind of taken over, at least this call, expected to be a big topic of conversation on the banks that have yet to report. How do you think Goldman is impacted on a go-forward basis? Because they have financing to private credit funds. They are affected, obviously, by the private credit funds that they have in their own portfolio, as well as the broader capital markets and the sponsor space and ensuring that flywheel gets turned on. So, how do you think the executives answered questions on the calls, and how are you feeling on the call, and how are you feeling about the go-forward basis with Goldman as it pertains to private credit?
Lovely, good to be with you. And so I was talking about this walking in to speak to you ahead of this. I do think they did a good job. I think, again, credit cycles are credit cycles. You can't run away from them. But I think David did a great job, I think, contextualizing what it means, what the debates are in the market around private credit. I know you've spent a lot of time covering the space in the last few months. And I think in terms of what's a liquidity issue versus a credit quality issue, and how some of the asset classes perform through different cycles, including the GFC. So I do think, again, you can't run away from it. As you rightly pointed out, of all the stocks we cover, I think Goldman probably has the most attached points to private credit, be it sponsor activity, their own FIG financing business, as well as their own private credit business, which honestly could be a market share gain opportunity for Goldman as you look out due to some of the dislocations we are seeing. So I think net, again, it was good perspective provided by the management team. And I think investors should somewhat feel better coming out of this. But again, we just need to see how the private credit firms themselves do and whether we see more headlines around credit losses over the coming weeks and months.
They had a bit of an increase in provisions in the quarter set aside for potentially bad loans. A lot of that has to do with the increase in activity, which was somewhat surprising, perhaps, to see an increase in FIC financing during the quarter, which some of that has to do with financing for private credit funds. How concerned are you about just the overall environment, overall credit quality? I think they mentioned just a few smaller impairments during the quarter, but just looking forward into the future, do you feel like credit quality, at least given the current macro backdrop, appears to be intact?
So how concerned are we? We are on high alert on credit. And again, I'm a banks person, having done this for 20 plus years. And I think the fact that we've not seen a full-scale credit cycle since 08 to 09, I think that has to keep all of us on high alert around looking for canaries in the coal mine. Are there any weak spots? So absolutely, I think you're watching. You're right. I think some of the credit impairments that they called out, it sounded like, at least on the call comments, they weren't quite directly related to private credit lending. So it's a tough time where credit losses generally are relatively low for the banking sector. So could there be a few bumps along the way given how good things are? Sure. But at the same time, as a result, very closely watching the macro to see if there's a part of it is, I think, analysts down a little bit wild, so I think there may be a lot of excitement discounted in that FIC number. We will have a better sense, though, having said that, FIC revenues were down 14% year over year, and we will have a better sense by Wednesday after all the big banks have reported whether or not Goldman was truly an underperformer or some of the areas that they highlighted, such as interest rates, credit, mortgage trading, were a bit of a soft spot across the street. I would not be surprised if that turns out to be the case. But again, the sample of one is tough today. I think it's definitely gotten a lot of attention, and we'll know better in the next 48 hours.
Absolutely a busy 48 hours indeed. Ibrahim, really appreciate your time today. Look forward to your continued coverage over the next couple of days with these big bank earnings. All right, coming up, CrowdStrike rising nearly 6% after Anthropic's Mythos threat took a bite out of the overall sector last week. Palo Alto, Zscaler, and Fortinet also higher. We'll look at what's at stake for the sector as AI continues to pose a threat. The exchange is back after this. Welcome back to the exchange. Markets right now all in the green to start off this week. You can see the Dow closer to the flat line, but the NASDAQ, the clear standout, up about 0.7%. The Russell up nearly 1%, near their best levels of the session. And here are some of the movers this hour. Revolution Medicine soaring after its pancreatic cancer drug succeeded in a highly anticipated phase 3 trial. The drug nearly doubled the typical length of survival and cut the risk of death by 60% versus chemotherapy, according to the company. RevMed said it will soon seek FDA approval for the drug using a commissioner's national priority voucher for quicker review. Shares of Dell moving higher today after the company announced that AMD had added the company as a commercial PC customer for the first time. The stock hitting an all-time high back to its relisting in 2018. Shares of AMD flat on the news, but you can see Dell at more than 6%. would join the NASDAQ 100 before the bell on April 20th, replacing software company Atlassian. Sandisk up nearly 7% on that news. And the cybersecurity ETF bug making a comeback today after closing down more than 5% last week on the elevated threat from Anthropic's Mythos model. But there's still a lot on the line for the companies looking to prove their relevance in the face of advanced AI. Our Seema Modi is following this story closely. Seema, feels like a really high bar, an increasingly high bar for them to prove that still exists.
Yeah, and time is of the essence now, Leslie. We will have both CrowdStrike and Palo Alto Networks. These are the two biggest names in cybersecurity. They were among the 40 companies that got to preview Anthropic's Mythos model. This is the AI model that is deemed so powerful that if it's released to the public right now, it could essentially break the internet. Now, the street is anticipating updates from both cybersecurity giants, Palo Alto Networks and CrowdStrike this week, upgrades that they're making to their security architecture to counter any cyber event tied to the release of Mythos. Their update could give the market a better timing on when the specific AI model will go live. And it comes as Goldman Sachs CEO David Solomon telling investors this morning on the company's earnings call that it's working closely with Anthropic and all the security vendors, adding that the bank is accelerating investments in security, which echoes what Wall Street has been saying for a while, with Mythos presenting a greater risk. Analysts at Wolf see customers really across Fortune 500 clients increasing their near-term spending as enterprises rush to bolster cyber defenses ahead of an impending cyber battle. So there's been this big debate that if there is a cyber event related to Mythos, Leslie, who's going to be able to fix it? Is it the incumbents in the cybersecurity world that we cover, or is it actually the large language model that created the AI model? And now we're expecting an update from the incumbents on what they can do to mitigate any type of risk.
And also pressing, of course, is what if that threat doesn't come from Mythos, but comes from something that's being worked on abroad, maybe the Chinese or another actor elsewhere. Given your technological know-how in the space, how well equipped do you think the incumbents are to ensure that the system is secure at this point in time, especially as this technology, innovation is changing so rapidly?
Yeah, the evolution is happening at machine speed. So the cybersecurity companies, what they're telling us is that they're making all the updates they can on a daily and monthly basis to ensure that their customers, which are across every sector, have the tools in place to identify the attacks, the vulnerabilities, and also the fixes that they can happen real time. But I will also point out the two biggest players here, CrowdStrike and Palo Alto Networks, have been on an acquisition spree over the last 12 months, Leslie, to be able to ensure that they have the AI capabilities to counter these new types of risks that are being presented right now. So again, the latest update we get this week, that will be key because this is going to be following the preview they got of Mythos. They'll have a better take on what can be done by their companies.
Yeah, Solomon was actually asked on their earnings call about the convening of bank CEOs last week as it pertains to this, and he did insinuate it's not the first time they've been kind of pulled together to talk about cyber risks facing the industry, but obviously they were in DC for something separate, so it was kind of a convenient time to talk about these newer risks that the industry could potentially face if it's unleashed into the wild, essentially.
That's why I included that comment, only because it's the first company to actually say there was a meeting, officially, and here's what we're doing right now to ensure that we've got what it takes to reduce any likelihood of cybersecurity.
Absolutely. So important to secure that very critical material data. Seema, thank you so much. Appreciate it. Now to Pippa Stevens for a CNBC News update. Hey, Pippa.
Hey, Leslie. Minnesota officials will investigate the actions of federal officers, including kidnapping and false imprisonment charges, according to the AP. The Ramsey County Attorney General and Sheriff said they will release more details at a press conference today. Ramsey County includes St. Paul, which was a major target of ICE agents just a few months ago. Representative Eric Swalwell dropped his bid for California governor late last night amid sexual assault and misconduct allegations. One former staffer alleged that she had multiple sexual encounters with Swalwell while working for him, including two in which she was too intoxicated to consent. Swalwell has consistently denied the allegations, saying last night that he will fight the serious false allegations that have been made. And there could be a new king in the ad space. Research firm eMarketer says Meta will surpass Google in digital advertising revenue by the end of this year. Google has long relied on its search business, while eMarketer says Meta's AI-powered Advantage Plus ad suite will drive the social media behemoth past Google. Leslie, I'll send it back to you.
Wow, what an inflection point there. Pippa, thank you. Coming up, President Trump threatening to slap a 50% tariff on China over a reported arms shipment to Iran. We'll discuss the country's role in the war next.
Discovery Houston, trim to ATO. Beautiful, beautiful.
Welcome back. Speculation mounting over China's role in the Middle East conflict, reportedly preparing to send arms to Iran. President Trump threatening a 50% tariff in response. Eunice Yoon joins us live from Beijing with more. Eunice.
Thanks, Leslie. Well, President Trump made those remarks to Fox News amid reports that China was preparing to send anti-shoulder anti-aircraft missiles to Iran. The foreign ministry denounced those reports as groundless smears and criticized President Trump's the main countries that would be mostly affected by this blockade. Not only is it an important economic and trading partner of terror.